Thanks, Mark. Okay, so let me start a little bit with my background. I'm sure some of you went out and looked at my profile. So getting ideas off the ground, or as we like to say, off the napkin, is all I've ever done my whole career. I started, when I got out of high school, I was an adrenaline junkie, so I really didn't want any more school, so I joined the Army and went and did Army stuff for a while, and then ended up at Fort Ord and ended up in California. And I got a job with a defense contractor. I've been on the design team of over 25 combat vehicles, a lot of modern stealth and night vision technologies. I helped develop a lot of those. Then I went over and jumped in the .com and got my first taste of .coms and startups and VCs and angels and all that stuff. So we went out and did one pitch, did our first pitch with our MVP, which they didn't call it that back then, but went out with our MVP, did our first pitch, and got a $25 million check. So those days are gone. Anyway, but it's nice to think about the good old days. They weren't that good, though. Anyway, so that was my startup on there. So I've been working pretty much in the startup environment off and on since probably 1998. I really got back into it in about 2010. I launched, shortly after that, I launched South Valley Angels. So we are a classic angel group. We meet once a month, and we fund the companies and those kind of things. I started GLJ Group in the end of 2004. When I first started that company, I was primarily doing business capture, new business capture. So writing proposals, going out and getting new business, and that kind of thing. I captured about $350 million for my clients between 2005 and 2013. I lost one proposal out of that time frame, so had a pretty good role there. But now I simply do one-on-one accelerations with startups, and we'll talk a little bit about that at the end. So this is pretty much what I do. I help startups get their ideas off the ground. I don't believe in bad ideas. I believe in bad execution. A good team and a good plan can execute anything. I always like to use the example. If everybody asks me, what do you think of my idea? Is this a good idea? Well, I think back to the idea isn't whether you're good ideas, whether or not you can execute on your idea. Because I always go back and use the example of the guy that came up with the pet rock. Hey, I'm going to put a rock in a box and sell it for 10 bucks. If you would ask me if that was a good idea, I'd say, man, that is so stupid. And I'd have been millions of dollars wrong. The guy made a killing for like 3 years. He sold millions of dollars of these rocks in a box, pet rocks. Anyway, so any idea can actually go out there. Okay, so that's my background. I've been doing this for a long time. I fundamentally came out of the systems engineering, project management, operations, business development kind of side of the house. So I've done a lot of things of getting ideas off the ground. That's pretty much all I did. So we're going to talk a lot about some of the general fundamental aspects of this, and we're going to talk about some of the just core things to understand. So we're going to talk about a variety of things. We're going to talk about what it takes to get your business going, various life cycles, and we're going to talk at the end. We're going to wrap up and spend the last probably hour just talking about how to get your message out and how to do a good pitch deck, how to really make yourself stand above the rest of the crowd. So let's get started. So let's start with the foundation and get everybody kind of on the same page here to begin with. So let's talk about the kind of life cycle of a business. So I've put these in the terms that most of you have probably heard so that we can kind of get everybody on the same page. So I'm sure you've all heard about bootstrapping. I suspect 99% of you in this room are probably in that phase right now. Okay, so bootstrapping in this phase right here, this is what's expected. Today, this bootstrapping is where you're going to write your plan. How many lean startup folks we got in here? Okay, so now you're going to be working on your lean canvas, all that stuff, going out and talking to your customers and creating the idea that you think you want to do and how you're going to do it and what it's going to look like and these kind of things. Okay, you guys, we just started, so you haven't missed anything yet. So this is the beginning of it. So you're going to do your business plan, your lean stuff. You're going to go out and talk to customers, figure out what you're going to do and so forth. And you're going to start building your MVP or your prototype. Now, in the example I gave you back when we went out and got our funding on my first startup, you could pretty much go out with a good team, a good smile, and a pitch deck and have a reasonable good chance of getting funded. You didn't need an MVPs. You didn't need any of that to talk to angel investors. Well, since then and now, the bar's been raised, so most angel investors now are expecting to show up with an MVP or a prototype or something now. They're expecting that to be your skin in the game, which is this phase here. It's expected that you pay for this phase. Now, that doesn't mean there's not investors out there that will pay you to do that, but normally This is where you're going to get your friends and family or good connections, people close to you that might give you a little bit of money to sustain you and get you going and so forth. Then eventually you're going to hit this wall and you're going to need more money. And so now you're going to have to go out and talk to somebody else to get more money to continue doing your idea. And this is where you need to make your decision. Are you going to go down a long-term debt type of a path? Are you going to go private investment? Or what are you going to do? So we're going to assume everybody in here is going down the private investment path. The problem with debt funding is if you need it, you can't get it. So it doesn't really become an option. Okay, so now when you get here, you're going to go out and look, and primarily you're going to look and talk to angels. And you're going to have to show up with a strategy, a plan, and an MVP. That's pretty much what's expected today. Now, you get your funding here. Let's say you're $500,000 or whatever, and that's going to be your seed funding to go out and actually go into market entry. Here you're going to go out, validate your product, validate your pricing model, make sure you have the right product at the right price. You've gone through, you've given it to a whole bunch of early adopters. If you're a software company, you've got thousands or maybe even tens of thousands of people using your software, providing you feedback, telling you what you like, what they don't like, and so forth. During this phase, you're going to take all that feedback and you're going to incorporate it into your product, and then you're going to be ready to go. Now you have the product that everybody wants, and in this window here, you found out how much they're willing to pay and what the market will bear. So now you have the right product at the right price. You've gone through and you validated it. Or you died in this phase, and then the next phase isn't that important anymore. So hopefully you got all that stuff back, and now you're ready to go out and get VC funding. So VC needs to see some traction, needs some revenue, but what's really looking for is, has your product and pricing been validated? Is there somebody out there that really wants what you have? And if you've got some things going and the answer is yes, then you get your VC funding. So here you got to show up with the product and revenue. Has to be revenue. Okay? So now they fund you to go what's commonly referred to as the growth phase, frequently Series A, whatever you want to call it. So it tends to be more of an institutional funding. And here's where you're going to grow growth. And now it's all about revenue. It's no longer about validating anything. It's about going to $60 million, $80 million, $90 million, and hitting your home run. Now at this phase here, if you're going to an acquisition strategy, probably somewhere in here you're going to get acquired. You're going to show up on somebody's radar. They're going to like it. You're going to get acquired. Or you may choose to go get some additional funding. I use the term institutional funding. VC funding is commonly referred to as institutional funding because it's somebody else's money. It's institutional money. And so here you're looking for growth. Another round would be for explosive growth to go out and go IPO. So this area here gets a little gray depending where the IPO happens, what your acquisition happens, whether you go A, Series A, B, C, D. One of the problems I have with the model in this valley is that too many companies seem to be in the business of raising money and not building businesses. It just seems like everybody's always focused on that next round of funding rather than making a sustainable business. I think that the model's broke a little bit in that aspect. I was in a meeting a couple years ago, and it still sticks in my mind. These two investors were trying to figure out how they're going to get their money out of this startup, and they were in their Series N. I had never heard of anything past the Series D. I mean, to me, I thought D was kind of like when are you going to go make money? So I have no clue how they got to N. I have no clue how any of those investors are going to ever get their money out of that. Now, I hope it's a pharma play or something, and they're going to make gazillions of dollars somewhere down the road. Okay, so this is the fundamental aspect of it. We're going to talk a little bit about this. Most of what we're going to talk about is going to be in this phase here to get you from here to here is most of what we're going to talk about. We're going to break down a little bit in detail. So ask questions as you go. There's no questions at the end. If you ask me your questions, we can gear this and tailor it towards your guys' problems and your gals, whatever you guys are working on, and try to answer your questions so you can get some real-time answers back from things you have floating around in your heads. So let's talk to begin with. So there's fundamentally three business models that I like to refer to. One is the traditional business model, which is based more on long-term debt. You get a little money, you build your business, you get some inventory, you do your thing, you get a little more money, you get a little more debt, you grow, and you sort of go through this long-term process of growing your business. The second business model is a franchise, where you buy the infrastructure, you wear the hat, you follow the check sheet, and you'll probably be fine. You'll probably be successful. And then the third one I like to refer to as the startup or the entrepreneur startup business model. And this model is uniquely different. At the beginning, it feels very much like a traditional model because you're still standing in your own garage doing whatever it was you're going to do if you're in a traditional model. But it changes very quickly after that. So let's look at the startup business model. The reason I want to do this is I work with a lot of startups that are trying to apply general business practices to their startup business, and the models are completely different, and they don't work. The strategies are different, why you're there is different, and so forth. So unlike a traditional business where it's about long-term debt, controlled growth, understanding, and all these kind of things, this isn't. This model is all about fast, explosive growth. It's done through private investment, not long-term debt. They're generally looking for short-term models within 3 to 8 years, not, oh, in 10 years I'm a financially successful business. So it's completely different. There's going to be a major event at the end of this, either an IPO or an acquisition. So this right here makes it completely different. Now people might say, oh, well, what, doesn't a traditional startup want explosive growth? Well, sure they do, but traditional businesses do it through long-term debt. So explosive growth is hard. It's more of a casual, you go, you grow, you go into debt, you pay it off, you get a bigger debt, you grow, and you sort of go through these cycles. Here, you go tell an investor, I need $500,000 to change the world and go do this. And then he says, oh, great idea, here's $500,000, go do it. So you get to start right off the bat with a full budget. So what are some of the challenges of this model relative to the other ones? One of them is loss of control. In the traditional business model, you own everything, you're responsible for everything, and that maintains throughout. In this business model, it's geared about selling equity in your company. There's an equity financial model associated with this, which is uniquely different than any other business model. Normally in a business model, you don't go out and sell your company, pieces of your company to people as you're growing. But in this model, you do. That's exactly what you do. You go out and you sell parts of your company to various people to come in and invest, be partners, provide you services, whatever the case may be. So you do lose control over that. In fact, it's not uncommon for a VC to replace the CEO completely and say, hey, you were a great CEO to get here, but you're not the CEO to go forward. We'd like to replace you. So it does happen. So there's all sorts of ways of losing control, but you got to understand that's the way the model works. And the reality of it is 100% of nothing isn't nearly as powerful as 10% of a billion-dollar company. So losing control, as long as you understand that. A lot of the startups I work with and the entrepreneurs, they get really, oh, but I don't want to give up the shares, and they're really concerned about that. But understand that that's the way the game's played. That's how you pay for things, is through equity. And as long as you understand that, you can work your strategies around that, and you can play the game right and come out of the end ahead. Okay? And then we talk about the dilution that goes along with that. And then the other one is actually getting funded. Getting funded is relatively difficult. Now, we talked about the fact of how the bar has been raised the way it is now, and that you show up with an MVP. Investors are getting more sophisticated. Entrepreneurs are getting more sophisticated. They're smarter when they're coming in. Now, there's more of these kind of things where you can learn as an entrepreneur. So the bar has definitely been raised in this raise. There's probably more entrepreneurs on the street now than there's ever been. And you're all looking for this, going to the same 35 investors trying to get money out of them. So the competition is fierce. And so that's why these kind of things are pretty useful, because you can't just show up like we did back in 1999 and have a nice smile, read the pitch deck, and get funded. You know, those days don't happen anymore. But on the flip side, there's more access to money now than there's ever been. There's never been Kickstarters and angel pools and equity nets and investors all over the place, and they're coming up. I just had a company talk to me yesterday who's looking to build an online incubator system that funds and does incubation across the board, no matter where you're located. So these things are coming and so forth. So yeah, the competition's fierce, but there's more money than available, and it's becoming mainstream, and there's a lot of things going on in that environment now. So the advantages of this business is you have a fully funded budget on day one. If you tell an investor you need $500,000 to do what you're going to do, they give you that $500,000. So there's no debt and a little nickel and dime here and a nickel and dime there, because we're not playing the game. We're playing the 2-minute drill. It's not about building something over 10 or 15 years. It's about making it explode in 3 to 5 years and being done with it. So, but you get the budgets to do that. So that's what's nice. So make sure when you ask for your money, you ask for the right amount of money. All right, so let's talk real quickly and types of equity funding that's out there and available, and make sure everybody understands the terms here. So we've got angels. So my group, South Valley Angels, we're a classic angel investment group. We do early seed funding. We do small funding. When we write a check, that check comes out of our bank account. It's our check with our name on it. It's $25 to $1 million. Band of Angels will go to $1 million. Most angel groups won't go that high. 500 to 750 is pretty much the max of what most angel groups will go to. How many women-owned companies do we have in here, or women-controlled companies? Okay, so you definitely want to know Golden Seeds. They only invest in women have to have 10% ownership of the company, or be in a major position of the company. So they only invest in women. So that's a plus. And they're East Coast, West Coast. They're huge, and they'll do $1 million. They'll actually go up to $2 million if things are just right. If they bring East Coast and West Coast back together. Anyway, so it's nice to know them. So that's your angels. Now your VCs, they're a little different in the fact that when a VC writes a check, he's not writing a check out of his wallet. He's writing a check out of somebody else's money. So most of the pensions that are in the United States, that's what the VCs use to. That's what's used to create these VC funds or pensions, because there's no way they can pay these pensions without huge returns on their investments. A CD won't get them there. So they create these giant funds. So when a venture capital writes that if he loses enough deal, he doesn't lose any sleep. He didn't lose a dime. He got paid really good to lose money, and then he gets fired and goes somewhere else and does it again. But angels feel it all. Now, the VCs, they do the A round, B round, C round. They tend to be big, $5 million and up. You're seeing a trend now where you're getting more VCs now that are calling themselves early stage VCs. And some of them will go down to as low as $500K. So it can be really advantageous to come in and get an early seed from a VC and then stay in bed with that VC all the way through your acquisition. The downside of that is they're going to take a whole lot more of the company up front. But if it's a one-time deal, they take your money and you know where you stand, and from there you're good until you exit. That has its advantages, because then you don't go back and look for more money later and so forth and so on. So we're seeing more of them doing that. Now we got this group called super angels. They kind of came out because of this gap between here and here. It was kind of like back in the day, like when we were looking for money, if you wanted $2 million, it was hard to get $2 million. Angels would give you $250 and VCs would give you $5 million and up, but there was nobody out there to give you $2 million. So it was like an awkward number. Then some of these super angels came up. I don't know a whole lot of super angels in this valley, but I wanted to put it up there just in case you hear that. Yeah?
Are angels different than friends and family?
Not necessarily, no. An angel just means that they write you a check out of their pocket. It's their money. So friends and family could still be angels from that perspective. Traditionally, when somebody uses an official term like an angel, it generally means that they're an accredited investor with $200,000 in income, have had it for several years, will have that. They've got $1 million in a car, those kind of things. But it's not really any real different. From your perspective, it's similar. You know, generally anybody who writes you a check, you could say to a degree was an angel. Yeah, so, yeah.
Does an angel sign just one check or make it stage by stage?
They can do stage by stage, but normally what really happens is, so let's say for example you go to an angel and he says he's going to give you the $500,000 you're asking for. Okay, they're never going to give you the $500,000. They're going to do it. They're going to do it in performance milestones. So they're going to say, okay, we'll give you we'll give you a first 100K, get this done. If you get that done, we'll give you the next one. If you fail to deliver on that, then we'll decide what we're going to do after that. So you rarely get all the money up front. I mean, almost like never. But they will do different stages, but not too many. So we'll talk a little bit about where they come in and feed when we talk about the plan. Good question, though. Okay, so that's the fundamental formal folks. Now, we have corporate venture. Intel's the granddaddy of that. They were the first real VC investment arm out of a corporate. Now, every Fortune 1000 company, and definitely all the Fortune 500 companies, all have a VC arm. They've all got investments arms. They all do it now, everyone. Intel, Google Ventures, GM Ventures, you name it. If it's a Fortune 1000 company, it's probably got an investment arm. So if you're making a product that's really geared for a specific company, a Sony or something, go knock on their door and say, hey, I'm looking for some funding. I would send you to Google Ventures, but that's a long line. Everybody's trying to get into Google Ventures. But anyway, so all corporates have that. So keep in mind on that, because that can be a good way to get money. Okay, now let's talk about what I call the crowdfunding folks. So we got different types of crowdfunding. Everybody familiar with Kickstarter? So Kickstarter is kind of the granddaddy here. And those are non-equity plays. Those tend to be really geared for people with hardware and consumer-facing hardware products, the kind of stuff you'd buy in a retail store. That's where the Kickstarters really tend to work best. They're not real good for software. They're not good for business solutions. It's really more of a consumer-facing. Not that they can't be, but that's not what they're geared for. The other kind of crowdfunding coming up now are things like EquityNet, AngelList. These are now lists of investors that you go in, you put your name in there, they say, hey, I like your company, they loan you some money. But in that, you're not giving them a gift or something like that. You're actually giving them equity. So they actually take equity in your company and they write you a check for that. I'd be cautious going down this road, because once you choose to go down that road, you may get stuck and not be able to come off that road anymore. So if you go in here and you get 100 people give you a $1,000 check to give you your $100,000 that you're looking for, now you decide you want to get some VC rounds. Now you paid for your seed area there. You've got your go-to-market. Now you want your VC round. You're going to go to VC. They're going to look at your cap table and go, holy cow, you got 100 people on your cap table? Non-starter. They're never going to touch it. There's just too many people involved. It's going to be too complicated. You got all these people with voting rights on the board and yada, 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 all this. So be careful going down this area, because it's going to be hard to come out. Now, if you went down that area and nobody invested in you, then it's not a problem. But if a lot of people have looked at it and nobody invested or even sent you an email, you might want to think a little about your model and what your message is. Okay, I kind of put incubators and accelerators in this area too, because they're oh yeah, sorry about that. Yeah, go ahead.
For angels or equity, net, that kind of things, how hard it is to only give shares but no voting rights?
Shares but no voting rights. Interesting. Well, so if you're giving out shares, the way to do it with no voting rights, the only way to do that is to do it as a common stock is what you're probably going to give them. But if you give them common stock, they get voting rights. Okay, so you just have to stay away from common stock. But the problem is, now you give them preferred stock, and now they get dividends, and now they get first rights of everything. So that's why it's a difficult thing. If you give somebody shares in stock, they by default have a voting right. So most of us, how many people out there have gotten that card in the mail that says, hey, we're doing our board of directors, here's 3 names, you don't know any of them, we recommend yes. So you go click, 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 and you send it back in. Well, you're voting for those one share of stock that you have. That's what you're doing. You're a voting right. And a lot of people don't even read those. They throw them away. And the problem is, if enough people throw them away, then they don't have a quorum, and they got to do it again. But anyway, so yeah. Sure.
First, does an angel investor usually use checkers or convertible notes? And the second question is, if they're not incubated yet, are you going to ask me to make a C Corp or a LLC?
Okay, good questions. Okay, first off, there's no right answer to the first one. So in the early days, the West Coast was convertible notes, strictly convertible notes. The East Coast were strictly warrants. And then they started merging. So now you get convertible notes with a warrant. So all warrants are is a little sweetener to whatever your convertible notes are. Convertible notes are the most common. They're the easiest to do. They don't require a lot of work. You make up a note, and if people like it, they sign it and get it. Sometimes the investors prefer getting straight stock, because once you have stock, it never changes. You have that piece of ownership. It doesn't, it sticks with you. You got it. You own it. It's not a convertible note that you get to pay for later at a higher price or things like that. But that's much more difficult for you to do as a startup. You have to get a bunch more things in place in order to give that out. On your second one, they're always going to ask you to be a C Corp. Mainly because LLCs don't have anything to give. There's nothing there. So they're going to ask you to be a C Corp. And they may ask you to to do it in Delaware, because it's got all the easy laws and it's vanilla and that kind of thing. Doesn't really matter where. But in many cases, I wouldn't necessarily run out and do that until you're talking to an investor. And then they say, okay, we want to do this, then you can do it. You can make a phone call to Harvard Business Services, and in 10 minutes on the phone, you can be a C Corp. They'll stamp it. By tomorrow morning, it'll be coming in the mail. You're done. $400. So it's not a long process. It's easy to do. But they're going to want a C Corp versus an LLC. If you're nervous about it, you can become an LLC until you move it up to that point, then become a C Corp if you want. Does that answer that?
Yeah.
Okay.
So convertible notes, I thought for some reason that you can ownership of convertible notes, or you can't?
You can, at the end of the day, but at the end of the day, a convertible note's a debt product. So let's talk about convertible notes a little. There's some interesting things going on in convertible notes, and I've always had a problem with convertible notes. Having spent 25 plus years doing research and development, there's a reason that research and development are cost plus contracts, because you don't know what you don't know until you get in and start developing and realize that, whoa, that didn't work very well. Okay, I'm going to have to try something different. So you frequently run out of money in development. Okay, not uncommon at all. So the risk associated with that. So now, when you do a convertible note, let's say a common thing is going to be a 12-month or an 18-month convertible note. Let's say, okay. At the end of that 12 or 18 months, that note comes due. You fundamentally owe those investors their money back with the interest that was in that note. If you don't, then you've defaulted on your loan, and then everything gets all upside down. Okay. So what I'm seeing now, and I think this has always been the right way to do it, I never understood why they've always done convertible notes with a date. So I'm seeing more convertible notes done by a milestone now. So rather than saying it's a 12-month convertible note, it'll say it's a go-to-market convertible note. Now, if that go-to-market takes 12 months, it's 12 months. If it took 13, it takes 13. If it takes 14, it takes 14. But they're doing it based on a milestone, not necessarily a window of time. So when that milestone, you have a milestone, here's all the bullets and checks that you're going to get accomplished in that. As soon as those are done, you could say, hey, we finished that milestone. And then your convertible note's done, because now you're ready to go out to the next milestone and actually get funded, which is really what you're holding up to do, either to go into business and make money or make that next transition and get your next round of funding, and then your convertible note then converts at that point. So I would recommend when people are doing convertible notes to look more at an accomplishments than a time frame. I've ran into so many companies that just the time came to an end, and they weren't done yet. And there's a lot of reasons they weren't done, and everybody knew they weren't done, but legally they either have to do another convertible note now, and if any one of your investors decides, well, I just want my money back, man, you're stuck in a rock and a hard spot now. What do you do? How do you give them your money back? If you had the money, you wouldn't have needed them. So anyway, yeah, so that's pretty common there. Yeah.
So the original question was, do people get more checks or do they get convertible notes?
Yeah. Oh, the check part. Forget about the check part. Yeah.
The convertible note doesn't sound like a really good bet.
Well,
So how does that differ from what's expected in payback when someone has
well, your term sheet lays that out. So your term sheet says what the conditions of the term are. And normally it'll have a convertible note in there, or it will have actual stock that you'll get X% of stock, just straight up, no convertible note, no nothing, here's equity. There's no checks involved at this time other than the check the investor gives you. One of the nice parts about this is what makes the investment model work is you don't pay anything back until there's been an exit. So that's what makes it really completely different from loans. There's no payback until everybody exits. So the idea is, I need $500,000 to do this. Here's your $500,000. You go do it, and then you look at your next round of funding, or you're going to get acquired, or so forth. So there is no funding return. Did that help? Was that?
Almost.
Go ahead.
I still would like to know, because what I heard, correct me if I'm wrong, is that there are situations where basically one of the approaches is that you open a convertible note, but what happens is that you, when the time comes, when there is a certain valuation of the person with that convertible note will own a certain number of stock.
They will. That is correct. It will convert.
So yeah, that's my question. Can you, this convertible note, can I offer certain ownership of the company with the convertible note?
Yes, but not at the same time. So the convertible note is going to be, say, something like, you're going to give me some money for 6.5% interest, and let's go back to a time frame for 12 months, of which it's going to convert. So what that's saying is within that 12 months, you're going to get another round of funding, and it's going to convert to something, and that something is going to be stock. Rarely is an angel going to buy his way out of there because you just got the big chunk of money and you're about ready to go up the hockey stick, so to speak, so they're not going to get out. So then they're going to convert. But now they're going to have to buy their shares based on the amount of percentage that came out of that convertible note based on the new valuation of the company. And normally what you'll do is you'll give them a discount. So if the VCs coming in are going to buy your shares at $1 a share, let's say, then you'll probably give the angel investors a 20%, 30%, 40% discount from that. So instead of that, they'll pay 80, 70, 60 cents instead of $1. So they got their shares at the end of that. They got them for less, but the valuation went up on that as well. So what they got kind of went up along with that. It's kind of a math thing, but yeah. So that's kind of where that works. But so is that more like what you're looking for? Yeah, it always converts into the next round. Now, yeah.
But if you don't have any value, how can you value what you convert it to? So you basically, when you go from a convertible promissory note to an equity round, right?
Mm-hmm.
You got to have some kind of value you convert it to. So,
That is true.
So how do you come up with a value that says your shares are worth? Right? So you have to go through the process of valuing the company, don't you?
You do. You do. And we'll talk a little bit about valuation. So primarily the thing about keep in mind about valuation, the valuation of your company is what everybody around the table agrees it is. There's no other formula. There you go. So because there's nothing to base the valuation of your company on. You have no, if you're an up and running company, the IRS has an absolute formula for valuation. Revenues, inventory, assets, yada yada, divided by this times this, yada yada. The guys here at Abbott, Stringham, and Lynch can tell you that formula. But in a startup, there isn't, because you don't have all those things of which you can tie numbers to and say, here's your valuation. So in my opinion, software in this valley is still overvalued. There's some other areas. I think fintech's a little overvalued because they're large markets, and they just overvalue them. Now, there's a gentleman here, Jeff, who is a certified professional valuation expert. So he does valuations for companies. Where you really need to get serious about that is, one, when you're getting ready to close a deal, because somebody has to give you a value in which to tie all the numbers to. And the other time is when you start giving out stock options from your stock option plan. You have to have a 409A valuation, which is an official document that says this is what everybody's stock options. So there's a couple times through your life when you'll have to have a real valuation. The 409A is done from as a perspective of a professional, where the other valuations, you may think you're worth $5 million. If that investor says, I think you're worth 2, and here's our term sheet, then you guys either agree somewhere between 2 and 5, or you accept his 2, because it's obvious they're not accepting your 5. So the valuation is a tricky thing because there is no formula for it. So you're always going to want it to be higher, and they're always going to want it to be lower. The investors will. So, okay, so let's start with this. So now you've done everything. You've done all your planning. You've done all your lean canvases and all that good stuff. You've talked to customers. You've got an idea. You know what you're ready to do. Okay, so you have your idea. So one of the things important as we're getting down the road. So let me ask you, from all you entrepreneurs in here, how many of you out here have a game-changing, completely, viral, I don't want to use the buzzwords here. So who's got some game-changing ideas out there? Disruptive. Who out there thinks they're disruptive? Okay. Disruptive ideas are hands down the highest risk, hardest to fund. But they also have the biggest upside. But they also fail more than anything else. Because disrupting an economy or disrupting a market is brutally difficult. So the important thing is to understand where you are. Most of you are not disruptive. Most of you are better, faster, cheaper. And there's nothing wrong with that. They're the easiest to get funded. They're the easiest to understand how they fit in the marketplace, because there's already stuff there. You have A, B, you can compare you. If you're disruptive, odds are there's nothing to compare you against. So nobody knows how to determine whether you're going to do it, whether you're not going to do it, what price do you charge, how do you get there. So all these things come along. So better, faster, cheaper, and lower cost. That's what 99% of the people are. That is the whole purpose for the entire SaaS model.
How do you explain Airbnb and Uber?
How do I explain them? Well, I would say that to a certain degree, Uber was somewhat disruptive, but not too much. I think they were disruptive a little bit to the environment. But Uber is unique because all Uber did was come up with a new business model. So they were kind of disruptive in that. So I would say they were kind of somewhat disruptive. You could look at Facebook. It was disruptive. There are disruptive folks out there, but it's very few, and it's few and in between. I mean, at the end of the day, Uber didn't sign anything too spectacular. They didn't invent cars. They didn't invent taxis. They didn't invent public transportation. They came up with a new business model, which definitely changed the way we think about stuff. So I would say, they were definitely some that came up with a great idea. If you can come up with a new business model and not have to invest any money for anything else, that's a great model.
Yeah, but they're disruptive though.
Sure.
Varying degrees of disruptiveness.
Mm-hmm.
So it's hard to determine what is disruptive. I mean, Airbnb doesn't own anything either.
They do, and they've changed quite a bit in the business. They're somewhat a disruptive company. Yeah, there's a lot of disruptive companies come out all the time, but most of them fail because of the amount of work involved. So if you have a really good vision, a disruptive vision, it really is important to line up with an investor who's got that same vision, because it's probably a long dance, and you're going to have to go back to the well several times. Uber didn't do it overnight. Uber's gone from doing well to bankrupt to almost going broke overnight to coming back. It was a long battle for Uber, and they still haven't figured out all the legal stuff yet. They're still fighting lawsuits. So we'll see whether if they can hang in there, they'll be okay. Okay, so obviously the other one is game-changing and disruptive. So understand which one you are, because there's different models and different strategies for both of those. And a lot of folks, everybody wants to latch onto this disruptive game-changing, and then they go down this disruptive game-changing model and make life so much more difficult than it needs to be. It's not like that. So make sure you understand where you're at on there. The other one is, again, go back to think of the business model, the intent of the business model. So I always like to argue with this one with my fellow investors. How many people out there, so we talk about what is the intent of the model? Why are you building a business? So if you look at a lot of people, they'd like to say, what's important to building a business? A sustainable business, all these kind of things. Well, I would say that let's step back and think of it in simple terms. The purpose of this model is a 10 times an investor return. That is what this model's geared on. And if you think about it from that perspective, if you're able to give your investor his 10 times return of an investment back, then you probably did everything right. If you did too many things wrong, then that objective won't happen. Yeah. As fast as you can. As an investor, tomorrow's a good day for me. I'll give you money. Give it back to me tomorrow. So time frame's the wild card. Huh? Yeah. When I do a business model, I try to get people to write fundamentally a 3-year plan. And basically that says you're showing up with an MVP or a prototype. You got 1 year to put it out to do your go-to-market. Get your feedback, get it incorporated into your product, get all that stuff done, make sure you have the right product, then probably 2 to 3 years for a growth phase, and then try to be done by then. The reality is most VCs right now, they're suffering with about an 8 to 9 year return on investment, which is more than they want. They like 5. It's not happening that way very often. Yeah.
On that 8-year return of investment, that's not the 10x, is it?
Uh-huh.
So it's 8 years to get the 10x return that they're looking for.
Correct. Yep. So angels like to see and when you're looking at the angels, they'd like their convertible note to be like 12, 18 months so it goes and they get that next round of funding so that 3 or 4 years down the road they're getting their money back. So that's kind of how that goes. We'll talk a little bit about it when we get back to the plan here a little bit. But the point is the 10-time investor return. So everybody out here always knows that the customer is always right? The customer's most important thing. It's all customer focused. So as an entrepreneur, who's your first customer? Probably the investor that wrote you that first check. So keep that customer happy. Because if you can keep him happy, then you're probably doing everything else right and you're being a successful company and it all works out. Plus, if the investors don't make their money, then this entire model dies and goes away, because if there's not investors out there to give money, then the investor model doesn't work very good. Okay? The second one is explosive growth, please. And the last one is have a plan. I am huge on planning. Of course, that's because I'm an ex-system engineer and a project manager. But planning is critical. You know, hope and luck isn't a strategy. I hear it a lot, but have a plan. It's amazing. So everybody says, well, but plans kind of lock you into something, you know. And keep in mind what a plan is. You plan, you execute, and you adjust. Constantly doing those things. But if you don't have a plan, you have nothing to execute, and then you can't adjust. You're just sort of winging it and going down the road. And every once in a while it happens. You come out the other end and you go, wow, I was successful. How'd that happen? Okay, so now you understand where you are. So now you're going to go out and start talking to people. Yeah, go ahead.
With the 10x investor return, what's the rate of company they want to succeed to be break even in the market?
All of them.
20%?
All of them. Heck no. Nobody goes in with the idea of losing. Now, the reality is most angel investors on average get a 3.2% return on investment, just for reference. The 10% is kind of came out of the valley and so forth, and it's really more on the VC side of things because they're investing in such large amounts of money and they're the pensions. They have to get those returns. So they'll invest in a lot of things and let 9 of them die so that one's successful. Angels kind of go through that road too, but on average they get a 3.2%. So 10 times is just kind of the word. It's a buzzword that came out of the valley. It doesn't really mean anything, but if you talk like 10 times return on investment, then everybody likes you. But it is the number that all investors are going to say, hey, how do I get my 10 times return on investment? Okay, so let's look at the key walkaway points now. So the primary thing that we're going to do here is investors invest in opportunities. How many people say, oh, investors invest in teams? Investors don't invest in teams. They don't invest in companies, and they don't invest in products. They invest in opportunities. What they use is the product, the team, and your plan to measure whether you're the person they're going to invest in that can capture that opportunity. Investors invest in opportunities. That's what they're there for the opportunity. So what you're trying to convince them is there is an opportunity and you have a solution. Keep in mind, a solution, not the solution. All interpreters think they have the solution to the problem. And if it's a big enough problem, there's lots of solutions to that problem. You have one of them. Okay, so you have a solution to solve a problem necessary to capture the larger share, to capture that opportunity. So most of the startups, and we'll get down to that a little bit later, 99% of the startups I work with, when I ask them what problem they're solving, they have got some tactical problem they're solving. Oh, profiles take so long to fill out. We have this quick system that does that. Wow, how do you make money off that? So your problem you're solving is not tactical. It has to be a strategic problem. And we'll talk a little bit more about that. So you have a solution to a problem. The reason I say that is because when you're developing your message, you get to pick whatever problem you want. And you get to pick how that all works together. And you get to pick how you define the solution. So if your opportunity and your problem and the solution don't fit like a hand in glove, shame on you. So I see that a lot. I see an opportunity, then I see a problem, then I see a solution. And they look like they were written by 3 different people in 3 different companies. I'm going, wow, they don't even connect together at all. So there's a key to that. So that's number 1. Number 2, you have an executable plan and you understand the cost. Most young startups I work with have no clue on their cost. I worked with one not too long ago who was already floating proposals out to large companies like Airbus and large aerospace companies asking for money and funding. He'd never even done a cost model. He had no clue what it was going to take him to run his company. He had no clue what it was really going to take. He had a pretty good idea what it might take to get a prototype built. But other than that, he had no clue on the rest of his company. So how do you know you need 100,000? Well, it seems like a good number. You know? Wow. Okay. So you need to have a plan and a cost to do it, because that's where you get your that's where they get to validate you, and that's where you earn your stripes, so to speak, is having these kind of things and looking like a mature company. The other one is that you have the right team to execute, and we'll talk about that in a few minutes. Now, the next things that are kind of lesser on the bullet, but you need to be aware of them. You're defensible. How are you defensible? Normally that's IP. You have patents. You have something going on. You have secret sauce. You have a 13 special recipe seasoning on your chicken, or you've got Coca-Cola's secret formulas, or you've got something out there that's protecting you. Now, you may just be a first to market. So your defensibility is to stay first to market and move fast. The other one is scalable. Make sure you can explain to people how you're scalable and why you can grow to $50, $80, $90 million within this 5-year window. And then the idea is the barrier to entry. This is really important when you're a first to market. Understanding the barriers to entry. And understand that there's 2 barriers to entry that I want you to think about. A lot of people get stuck on one of the barriers to entry. So most of the time when people are talking about barriers to entry, when someone says, what's your barriers to entry? They tend to mean they're asking you, what are the barriers of your competitors doing what you're doing and catching up with you and passing you, or those kind of things. And that's important to understand why they can't. That might be, oh, well, we have IP, or it's taken us 9 years to get here. If they didn't start 9 years ago, they're not even close. We know what it takes to get here. These kind of things. And it's interesting because a lot of people think they're dead in the water without IP. You're not, but it's important to do so, because if you fail at the end of the day, the investors will probably take your IP. And they'll go maybe find another team to give it to who might be able to execute this. Now, the second barrier to entry I want you to think about is your barrier to entry. What's in the way for you to go out and get successful and get out there? So think about it on both sides and understand those a little bit. Okay. Now, the last thing, you have an investor exit plan. Yeah, go ahead.
So how investors know they have the startup has the right to
How do we know? Okay, that's actually a good question. We'll talk about that in a little more detail, but it becomes pretty obvious. So there's key things. You have to have a technical guy that understands what you're building, that kind of thing. You have to have your business folks that can go in and knock on the door of all your big customers and get you meetings and get in there. You need to have some people with a small business experience. If your entire team is coming out of the corporate 1,000, I almost guarantee you're going to fail. Because these folks have never worked in a small environment. And I see it all the time. You got these corporate guys that all came out with a great idea. They're all been really successful in their business. They say, okay, we got to get this out there. We got to get our marketing campaign. Okay, where's the marketing department? Hey, that's you today, Bob. Okay, and they're like, that's it. They're saying, I don't know how to do that. I've never done this. So anyway, so you need some people, small business experience startup, to understand how all that goes. But we'll know how you have a team. We're going to talk a little bit about how to build your team and how to get the investors to help you with that. So make sure you have an investor exit plan, because at the end of the day, that's what we all want to know: is how do we get out of your plan? Yeah.
Can you quickly talk about defensible IP, because it costs a lot to go into the lawyer's fees to really have a defensible IP. So can you give some example of how we can do that with the bootstrapping?
Okay. The easiest way to do that is just to go out and file a provisional patent. They're not very expensive, and they're good for 12 months. That gives you 12 months to figure out whether you really want to go forward with that patent, whether you want to do the patent, whether you want to change the patent, how you really want to write that patent. So it gives you 12 months, which allows you to put a line in the sand that says, I filed a patent here. So now you've at least got a date. That's the earliest date you could possibly get, and you have a date on your patent. Now, from that point on, you may choose to not patent, just go out and do things in that 12 months. You may change your mind and just let it go away and die. But you're right, it's anywhere from $5,000 to $20,000 to file a patent. And patents are an interesting thing. They're kind of like life insurance. If you ask a patent attorney if you need a patent, he's going to say, well, absolutely you do. Well, he's a patent attorney. That's what he does. Okay. Do you need life insurance? No. Do you need car insurance? Well, now in this state it's legal. You do. But in many states it's not. How well do you sleep at night? Are you comfortable? So patents are kind of like insurance. You may go and spend $25,000 on a patent, put it in your drawer, and never ever pull it out again for 30 years. It's like, wow, I remember when you did that. That was a waste of money. But if you needed it, it was there. But if you didn't need it. So patents are a tricky kind of a thing. Yeah.
On the patent, you file a provisional by yourself.
You can.
Okay. Then who does the work of seeing if somebody's been out there ahead of you, something's rolling around in a
Yeah.
closet?
So you go to patent attorneys, and they'll have staff that'll do that. They'll look it all up for you. And that's really where the money goes. The money isn't in the filing the patent. The patent filing is not expensive. It's doing that search and having somebody that knows how to get into the system, has an account, can go in, knows how to search in your vertical, knows how to work it in there and find what's right.
So that's what you're paying for.
Absolutely. It's mainly that. Yeah.
There's also free patents online.
Yeah. The patent itself isn't complicated. It's the search and doing it right and getting the real detail out of it. And there's absolutely an art and science to it. Yeah.
Speaking about teams, so what are investors take from a situation when there is no team and there is just a solo founder, but he has a whole bunch of technical and
All right, the class of Army of One. Most investors don't invest in a single. The risk is just too high. You go out and get hit by a car tonight and the company's done. And there's no way to get now I can't get anything out of your head. So it's very difficult. So it's important to have a team. Not that it's impossible, but really rare unless they really know you and they're investing in you, which is what friends and family tends to do. They tend to invest in you as a person, not you as an idea in most cases.
So would that make sense then? Find a co-founder just for 10%?
Yeah, but that gets a little dangerous. I mean, you definitely want to build your team, and you got to do it through that process, and you got to find the right people. The hardest part is finding the right people. Building team is probably one of the more difficult parts of the startup business, because you're trying to hire. Everybody here wants the 5-star team, right? But you don't want to pay them anything because you don't have any money yet. So the negotiating is a little tough. So it's very difficult to do. Yeah.
How much equity do I have to own to be considered a co-founder?
That's a fine question. There's no specific amount. The co-founder is not dependent on the amount of equity you own. It's whether you were a co-founder or not.
Yeah, I know. What kind of situation are you hoping to find in order to?
From an investor's perspective? Well, from an investor perspective, we would like to see very little of the equity eaten up. So normally founders always start the same way. 99% of the time you have a founder, a co-founder, and they both take 50%. Which is not the right way to do it.
The brightest thing to do.
Not the brightest thing, but that's what everybody does. Oh yeah, we're co-founders, split it 50-50. All right. If you're the CEO, you always keep the larger piece. Yeah.
I just want to try to answer this question because I know that for example, Y Combinator, they consider 10%. They consider a co-founder as to have 10%.
A A co-founder is 10. Yeah, and that's their policy. So where's the other 90%?
Well, why see they say 10?
So a co-founder gets 10. Okay.
Well, at least they say that, all founders have to have at least 10%. That's when they consider you a founder.
Okay. Not sure where that number pulled out from, why that's any more valid than 15 or 20 or something, but okay, fair enough. 10's good. Well, I mean, there's, as a co-founder, to me, the definition of a co-founder, you came in and co-founded the company. You brought, between you and the folks on there, you started at the beginning and you went through. But as a co-founder, I'd be shocked to be a co-founder and not have at least 10%. I mean, at that point in time, and you're looking at advisors at 1%. So if you're a co-founder and you're really working 40, 60, 80 hours a week with this company, I would hope you have more than 10%. But that's a tricky one. That's really a case-by-case, company-by-company. I'd say there's no real number. I'm surprised that they lock it and say that a co-founder has to have 10%. But that's their rules. Okay, what do you need? Okay, so now you're going to go out and you're going to look for this. So you got to have documents. This is the business world. You can't do anything without paperwork. Everything has to have paperwork. So you need to have 3 primary documents. An executive summary, which in the industry standard is 1 page. A pitch deck and a presentation. Industry standard is about 10 minutes. So you're looking at between 8 to 10 pages that can be given in 10 minutes or 6 minutes. Those tend to be, for whatever reasons, those are numbers that this valley has decided are the right numbers for pitching. We're not talking the 2-minute elevator pitches here, but you should be able to do your deck within 6 to 10 minutes, or even longer if need be, and a plan with financials. Got to have a plan. Now, whether you've really truly written out a plan or you're calling your pitch deck your plan, you definitely need to have the financials. Now, I'm big in writing a plan. I feel that if you're running down the road and you haven't done a plan, then you've just set yourself up to fail, myself personally. So I think that everybody has to have a plan. I'm sure everybody out here has heard you don't have to have a business plan to get funded. And there's some truth to that. The value of a business plan, and I don't even like to call it a business plan, because you folks here are all in really brand new small companies. You have a plan. There's no design plan. There's no manufacturing plan. There's no business plan. You have a plan. It's probably 9 pages at most. But have a plan. Write it down, because until it gets on paper, there's no other way to communicate what's in your head to your team. How do you communicate what's to your team if you haven't put it on paper? Say, hey, here's our plan. Here's what we're doing. Here's our this. Here's our that. If it's in your head and it can't come out, and that's one of the things that cause a lot of startups to fail, is the visionary, the CEO or whatever, they have everything in their head. They don't do plans. They don't do requirements documents. They don't do these kind of things to communicate what's in their head and get it out so the rest of the team can actually execute to the vision. And so you need to have a plan. The plan is more for you as a CEO than it is for anybody else. It allows you to communicate. It allows you to look at it. You'll be surprised when you start putting things on paper. All of a sudden it starts getting real, and you come back and look at it and go, well, that's kind of a lame idea. Why would I do that? And then you can scratch it and change it. And these are important to go through this and put them on paper. It makes all the difference in the world. So I'm big about writing plans. Doesn't mean you're ever going to show it to anybody. What you will do, though, if you do do it right, your pitch deck should be a summary of your plan. I should be able to look at your pitch deck and understand what your plan is with enough detail. I probably don't need to see a detailed business plan. What I'll do is ask you to bring in your financials, because all you're giving me is a little summary that says you're going to go from 0 to $500 million in 3 years. I'm going to say, wow, how are they going to do that? And so, believe me, every startup I work with, they're all going to be multi-$100 million companies in 4 years. Look at the financials. It's mind-boggling how fast these companies grow. Okay, so those are the 3 things you have to have. And in order, you actually do them the other way around. In the real world, you do that first, then you do your deck, and then you zero it down to a summary, because it's hard to start with this. And I can look at executive summary. I can read an executive summary, and I can tell you in 30 seconds whether you've written a plan, just by looking at your executive summary. Guarantee it. That comes with reading thousands of them. Because when I see one that's not done with a plan behind it, there's a lot of arm waving. There's a lot of we're going to do stuff. There's very little metrics. Nothing's dialed down. Nothing's brought in and says, okay, this is, hey, we're going to do stuff. We're going to build some teams, and we're going to go viral. What kind of what? In the financial plan? Okay, so in the financial plan, we'll talk about it. We're going to talk about the same organization, but I'll hold on to that question until we get to the pitch deck, because when we get to the pitch deck, it's going to be the same topic. You may word them a little bit differently, but the last one, when it comes to plans, do not go out and download a template. Just write a plan. We want to know what you're going to do. We don't want to know that you can fill out a template. We just want to know what you're going to do. So write your plan. The financials now, there's two types of financials. If you're going out to talk to angels, let's say $500,000 kind of stuff, you can get away with what I call an engineering financials. And that's the ones where you sit down and take your spreadsheet and say, okay, I need to buy some stickies, I need to get an office, I need to get a computer, I need this. You make a whole list of everything you're going to need, and you start running down on how much that's going to cost and when you're going to buy it and those kind of things. Then you're going to do your projections on these kind of things. You're going to do some labor, and it's all done simply. We can then take a look at that and say, okay, the fundamentals look like he's captured kind of everything here. Now, when you go to get real money, like $5, $10 million from a VC, that engineering is not going to work. You're going to have to go and call Mark and say, Mark, I need a real financial model done by a CPA. They're going to want to see all sorts of stuff, baked into the financials so that they look real. But they're giving you more money, so fair enough. So for most of you, an engineering model will get fine. Just list all the things you think it's going to cost, spread them over 5 years by month. And I'm glad Mark likes accounting because cost models just kill me. They're so time-consuming. I mean, and you get it all done. You spend weeks doing it, and suddenly it's not working, and you got one typo in there somewhere in one of the 42 tabs, and it's just not rolling up. Anyway, it takes a while, but they're critical. You have to have them, and you need to understand them. Okay, here it comes back to that right team. So we talked a little bit about what you need on the team. You have to have the person who understands it. You have to have the business people, somebody with some startup experience that's worked in a small environment and understands the agility and the fact that you can't force Lockheed policy and procedures on a startup and expect it to survive. Then you have to have the specialty people. So when we talk about specialty people, those tend to be your advisors. And one of the early advisors you should always have on your team is a legal advisor, somebody to help you with the legal stuff. As soon as you start making money and moving stuff around, you probably want somebody like a CPA or an accountant on there to make sure that all the money you're going is not going to go to Uncle Sam next year because you failed to do anything this year about the money you were making. So when these kind of things come in, but normally what you're looking for are vertical slice people that have specific knowledge sets that you don't necessarily want to bring them on your team as a full-time person, but you may be in a highly regulated environment, let's say, and so you need somebody that understands the regulations. So that's normally where the advisors come in. Advisors are normally between 0.5% and 3% at the most in equity. Most advisors are 0.5% to 1% if you're going to use them fairly often and ask them questions. At 1% to 3%, they better be bringing some things to the table other than answering your questions, and they better be spending a little bit more time. Yeah?
Investing or grants immediately?
What's that?
The 1% you're giving the company, are you going to invest that?
You always vest it. You never give anything up front. There's no incentive then. So 4 years is standard. But a lot of time on advisors, you may do a smaller piece and do it maybe in a shorter window. It's all up to you how you do that. But definitely you don't want to do it up front. And when you're bringing people on your team, I would also do a tiered vesting on that front too. So maybe somebody comes on your team and they're going to work for you and they're going to work with you for free because that's the budget you have. And you're going to say, hey, I'll give you some stock. And they're going, oh, great. So maybe you say, tell you what, it's 60 days, we'll give you some shares because you need to see how they're going to perform. You don't want to give them the shares up front, have them flake out on you, disappear, and now they own your shares. You probably don't want to go to a 4-year vesting because now they got to go a year before they get any, and you want to keep them motivated. So you might want to look at some little bit of shares that come in like a 6-month, 60-day, 9-month. 6 month, 9 month kind of a thing. And then at 12 months, then it can go to maybe a yearly to keep them motivated and feel that they're getting something out of it. That's kind of a deal. But what I find a lot is that people go and sign on advisors for like 5% and things like that, which that advisor better be bringing a home run tomorrow by lunchtime for 5%. 1% is a common denominator for those kind of things where people you're going to expect to spend a few hours a week and they may stay on board for a while. Yeah, you go up to Palo Alto, and it's amazing how everybody wants 5%.
So all
Yeah.
those team members except the advisors should be full-time.
Correct. These folks here are part of the team. These guys here are not. And let me talk a little bit about leader here. Back up here. Okay. So leader's an interesting one. Has anybody heard the term Moses factor? So I kind of use that one a little bit, and it's becoming a little more popular. So you ever hear the story where somebody just walked in and talked to a VC and walked out with $10 million in funding, and it didn't seem like they even had an MVP or nothing, but you read about them in the newspaper all the time. And a lot of times that's because they either know somebody closely. And one of the things that happens is one of the things that VCs in particular and investors are looking for is real leadership out of your CEO. And I refer to that as the Moses factor. And what they're looking for is when that person walks in a room, we've all met those people. When they walk in the room, you talk to them for 5 minutes, you're like going, oh my God, I'd follow that person anywhere. I don't care what that person does, they're going to be successful. They just have that ability. You see it. As soon as you talk to them, they've got that confidence, they've got that vision, they're going. And VCs and investors really look for that because at the end of the day, your CEO is the leadership, the face of your company. And so they're looking for those kind of things. And unfortunately, most people aren't Moses. So it takes a lot of work to actually do that. Some people seem to come natural with it. They just come in and they can command a room instantly. And everybody goes, oh my gosh, I'll follow that person. Steve Jobs is a classic person like that. As he got older and into his career, he was just that way. He had that confidence. People say, oh my gosh, I don't care what he's going to do. He's going to be successful. So I'm going to follow this guy. I'm going to get on his team. And so a lot of investors are looking for that air of confidence in that sense. Very difficult to do, but it is kind of key. There's a lot of things that are happening in the investment world right now because of the sophistication and the way it's moving and everybody kind of moving up the food chain. So back in the day when we used to be able to read a pitch deck and still get funded, like I was saying earlier, now there's a lot of expectation. They expect you to be able to come out and do your pitch with a nice little compelling theatrics that go along with it, this nice story, and all these kind of things. And a lot of people, that's not natural for them, so it takes a lot of practice to get up there and do that. The other thing that's key is the passion. It's important to have that enthusiasm and have that energy because they're looking for that, because that's kind of what keeps you going when you're not getting paid and some of these other things until you turn that corner and actually have a business and now you kind of have a job. Is that passion is what gets you up every morning and makes you go and makes you want to do it, and it allows you to sell your product and all that goes along with it. The other thing that's important, and we're going to talk a lot about this, is a compelling opportunity. Back to the fact that that the investors invest in opportunity. So it's critical to hook them with the opportunity. And what's an opportunity? It's large, it's in demand, it's growing, and people want it now. That defines an opportunity. We're going to talk a little bit more about that when we get to the pitch deck. So anyway, these are the key things you have to have. The document, the right team, and a compelling opportunity to understand your opportunity. When we get into the pitch deck, we're going to talk about that because most entrepreneurs are what I refer as tech focused. They're focused on their technology, which is natural. All parents love their babies. Everybody loves to show pictures of their babies. So as an entrepreneur, you spend a lot of time creating whatever it is you're creating. So of course you're proud of it. You want to see it. You want to understand, and tell everybody about that. But we're going to focus away from that and onto the opportunity, and not so much onto the technology and the product itself. Yeah, go ahead.
What kind of for getting to the seed funding or angel funding? What's a good size?
A good-sized team? Well, a good-sized team would be 1, 2, 3, 4.
We have a situation, we have advisory which is much bigger than
Not uncommon. Are any of those advisors going to come on board if you get money?
no.
Okay. So, are you a software company? And you're outsourcing your development? Okay, so you're probably going to have a CTO who manages your startup guys. You're going to have the business folks who's going to run the business, and then you're going to have you as the leader here that's going to manage everything. So, today's companies in the software business, big isn't important. So it's interesting to show that the 90% of all companies in America are less than 10 people. So companies don't have to be large in numbers. What you need is to have a little bit of everything. So if I don't see a technical person, which is pretty rare if you're building a product, so what normally we see is we don't have the right business person here. We got the CEO and the tech guy, the CTO who are working together, but frequently they don't have the right business person in there. That's normally the one that's missing. And that is probably the biggest one to give you a leveraged unfair advantage. Yeah. A business person. Okay. Yeah. So it's all about sales. It's all about generating business. So it's understanding your vertical market you're in. So when it comes to people like sales, anybody can pick somebody off the sidewalk and say, hey, go make 5,000 phone calls and set up a meeting. And anybody can do that. And give them long enough, they'll eventually set up a meeting. Where your leverage advantage comes from is having your business person having direct access to the top companies that are your customers and can make a phone call and have a meeting tomorrow at noon. Not, I can call 5,000 people and might have a meeting by March. You know, anybody can do that. The business person is the truly unfair advantage you can have. So I helped launch a company last year, and a buddy of mine I was working with them, and he had just retired, and he was the classic 800-pound gorilla in this company's space. So I called him up and I said, hey, Paul, I need to get you out of retirement. You know, I think here's a company you ought to go. So I brought him on board and schmoozed him for a couple months and made him the chief sales officer. And these guys are they sell a kit that goes on pickups, and they sell their trucks to fleet managers. So they're a fleet sales. And Paul was the director of the National Automotive Center for the U.S. government. He bought every truck that the U.S. government uses. Every single person that has a fleet, he started every hybrid fleet initiative for the government. Everybody in the industry that wanted to sell something to the government, he knows them. So he knows every one of the competitors. He's been in all their vehicles. He knows anybody who's got a fleet of 10,000 trucks or bigger. He started every initiative in hybrids. You just type in hybrid truck, and he's the picture that pops up. So I got him on board to be their chief sales officer. And he's knocking them dead now because he knows everybody and so forth and so on. So that's where you can have your biggest unfair advantage as your salesperson and your business person, having somebody that's got a direct line to the key decision makers within the customer base that you're going after. It is. But if it was easy, they wouldn't call it work. Okay, back to what you need. Remember, as a reminder, for angels, if you're going to go talk to angels, you got to have an MVP to go talk to them. Now again, everything we say in here tonight, you can always find an example of somebody who's done it without these things. But don't bank on that. So we want to have an MVP. If you go talk to VCs, you got to have revenue. Okay? All right. So now let's talk a little bit about the decision flow and how all this works. So the first thing you're going to do is you're going to run into me and oh, go ahead.
I'm not going to talk about having a prototype or MVP in which situation, the kind of app you're building or something needs so much investment that it's very hard to get the right MVP, but you would go with the prototype, what that dynamic works.
One more time.
Okay, more or less, some situation or app needs so much investment to get an MVP.
That'd be called a medical device.
Sorry?
That's common in the medical device.
Okay, or
Yes.
others. And so what's the dynamic around here with angel investors? That's common. How this?
It's difficult. It's difficult, but keep in mind, there's two types of angel investors. You've got mainstream angel investors, Band of Angels, Sandhill Angels, and the various investors that work in that environment. And then you've got the folks that are just individuals out there that have deep pockets and occasionally make investments. Those folks you can get away, and those are the folks that tend to want, a lot of times, get in a little earlier and do some of the bootstrapping funding and so forth. As you work your way up to the more formalized investors, they're just more sophisticated now. They're just not going to take the risk if you don't show up, because that's where the biggest risk is, whether or not you can ever build anything. So it's just the way the mainstream. So anytime there's a mainstream, there's always the underground railroad that goes along with that you can also do your own thing that doesn't fit any of the rules. Does that help? Okay, so now you're going to come and you're going to say, Gary, I got a great idea. I want to come pitch to South Valley Angels. I'm going to say, cool, send me your executive summary. So we're going to talk about those. So that's the number one. That's your resume for your company. If you want a job, everybody says, give me your resume. Okay? When you go to talk to investors, they're going to say, give me your executive summary. That's just the industry standard, so you need to be prepared to give that to them and have that for them. So now you give me that executive summary. And then we're going to take that and we're going to review that and screen your executive summary. And that happens through a variety of things. So in my particular group, we screen the executive summary. If we like it, we'll invite you in to come pitch. Okay? And then we like a lot of the groups, we meet once a month, and we listen to X number of pitches. In our case, we listen to 3. And we have you pitch. If we like it, we'll call you back. Now, this screening process can take a couple different formats. So, for example, Band of Angels, Sandhill, Carol at Angels Forum, they have screening committees. So you may be asked, you may send an executive summary and say, hey, we liked your executive summary. Why don't you come on in and pitch? Well, you're not actually coming in to pitch to the investors yet. You're coming in to pitch to the screening committee, which is still feels kind of the same, only it's a little less formal. You're sitting around a table. They'll probably give you a half hour, maybe, well, probably about a half hour. And you'll give them their pitch. They'll talk to you and so forth. But you're still in the screening process. Then you'll disappear. And they may come and call you back again in a week later and say, hey, love the pitch. We'd like you to come in and pitch to the investors. So in that case, you may actually pitch a couple times before you actually get to the pitch. Now, when you get to the pitch, you're going to go in for 10 or 15 minutes. You'll do that in front of the room, all the investors and so forth and so on. And then if that comes out and they're done, they come back and say, hey, we liked your pitch. We want to go into what's commonly referred to as a deep dive. Now, this deep dive could take days, weeks. If you're working with Band of Angels, it could take months. I've seen them kick the tires on companies for 6 months and they go, we're passing. Anyway, so everybody has their range in which they do that. At the end of the deep dive, we have never had a company go through deep dive and come out the other end for due diligence and not get funded. So the deep dive is really the due diligence. That's when everybody's understanding what's going on. They may have a CPA come in and look at your cost model. They may have a coder come in and look at your hot algorithm that you said is totally cool and nobody has anything like it. They may have some other folks come in and look at various things, and they're going to bring subject matter experts and go through what they're doing. And then they're going to come back at the end of that and go into the due diligence. Yeah?
How much of your IP are you revealing?
Probably all of it. So at this phase, quite often, that's a good question there. At this phase is normally an investor will sign an NDA. Prior to this, they won't sign an NDA. And you shouldn't be telling him anything that needs an NDA. Yeah?
Okay. For the financials, if you come back and have somebody like Mark make them up for you, will investors still want to do that same tear it apart analysis?
Absolutely.
Take a look at it and say, oh, this is from...
No, they won't do it. They'll take a look at it. Oh, we don't trust anybody. Mainly what they're looking for holes, just to see whether they consider it. Without knowing that, they can't know it. They could assume that it's probably good because it was done by a professional team, but they want to go in. Normally what they're going to look at is a couple things. One, they're going to go in and see how much you're paying each other, because they don't want you to be paying industry standard prices. You know, if you're normally making $150K a year, they're going to probably say, how much do you need to survive? $75K? Okay, give yourself 80.
Oh, the people inside.
The salaries, right. So they're going to be looking more at salaries and some of these other things just to see where the money's actually going in your model. But they'll commit and they'll spend whatever length of time. Because if somebody's like Mark's firm's done it, you and I probably no longer have a clue what's in that model. You know, at the engineering model, we understand it, but by the time Mark rolls them back and it's got 137 tabs and there's 82 lines on each tab, and we're like, whoa, you know, looks impressive. This has to be good. You know, so yeah, they'll come in and tear it up. Yeah.
So this process that is standard right now for how angels work, and
Pretty much, yep.
what's the like when it's single investor, when it's just a single investor?
Oh, well, that's a little bit different, because a single investor, you're probably just going to sit down and have lunch with them. You may not even do a pitch at all. You may just sit down and talk to them over lunch and say, hey, here's what's going on. And we'll talk a little bit about that on the different types of pitches and how you talk to folks. So those folks, you probably won't do anything. You'll sit down at lunch and they'll say, hey, that sounds good.
Do they still exist?
Absolutely. Sure. Yeah. Oh.
From your typical experience, what is the percentage of people that you have that have gone successful at different stages versus?
Wow. Well, most of them are weak. The odds are that most companies don't do well. Most companies takes a few times to get through the pipe. So what you'll normally hear frequently is, oh, you're just too early for us. Okay? That's kind of the equal to, we got your resume, we put it in the file, we'll give you a call when something shows up. You're too early is standard. Now, I always found that interesting when you get from an angel investor who does seed funding and says, oh, you're too early for us. Well, what's earlier than an angel doing seed? How can I be too early? I'm a seed. You know, what's before this? You know? So what they really mean is that your team is too early, not that your idea is too early. Normally what they're seeing is that the maturity of your team's not there. So they see things where your plan was a little bit weak, a little bit of arm waving in there. They just didn't get a sense that you were mature enough to go forward with your team. And that's pretty common. Which just means go back to the board, you know, tighten things up a little bit, you know, and come back again. And so we'll talk a little bit about how to tighten that up. It goes back to that Moses thing, you know. When you come in and it's obvious, so one of the questions you're going to get frequently from an investor is, so who on your team's, how many people on your team have brought a product to market before? And if the answer is nobody, then that becomes a little bit of a flag. It's like, okay, well, I've never done it before. So if you haven't done something before, there's no guarantee you can do it. But if you've done something before, you can probably do it again. So there's this kind of aspect of that in there, of where is it going. And sometimes, you know, it's obvious when you're meeting with people, it's like, wow, this is your first rodeo, isn't it? And you know, yeah, it kind of is, you know. And it doesn't take a rocket scientist to look at two 20-year-olds and go, have you done this before? No. You know, so now how do you gain experience? And that's where some of your advisors and some of these things come in. Yeah.
What about international startups? I mean, if one or two co-founders, they're here, they're ready, but main part of their team, they're abroad.
Okay. So then normally if the main part of the team and the headquarters is abroad, I'd say get money where abroad is. Now, if they're here local and they're connected, then get the money here. And I go through this a lot. So a common thing would be where you got two members of the team here, but the development team is your cousin in India who's doing his thing for you. And that's fine. So outsourced is fine. As long as your headquarters are here, your business is here, your CEO is here, you know, your CFOs, as long as those folks are all located here, you're fine. Then all you're doing is outsourcing your development. But if the bulk of your team is in another country, then most investors are going to say, go to that country and get your money because that's where you're at. And investors still like to invest local. So it can be a tricky thing. But with that said, there's also, most countries have an organization here in the Valley that will help you get through that. Whether you're German and you're going through GABA, or Korea and you're going through Kotra, or any of these other number of organizations that are from the countries that have set up here and to purposely do that cross-water. Let's see. Go ahead.
From the investing perspective, what does it look like when you just want to see the team mature a little bit? How does that no look as opposed to, no, we don't think your idea will ever take off and we're never going to look at this thing again?
So a couple things. What I would do is that if they'd say, if you're too young, I would always go back and say, great, well, we'd like to get back in touch with you afterward, you know, when we mature a little bit, fine. And some of them will just say, hey, you're a little too young, but we like what you're doing. You know, but you need to get a stronger team. You know, your plan's a little bit weak. You know, or you just weren't ready. And some of them will actually do that and say, we'd recommend you call Gary. And then I'll get you all squared away and you go talk to him again, which isn't uncommon either.
It doesn't like poison the well if you've already been in front
Not
of
necessarily.
investors?
No, it doesn't, as long as you haven't burned any bridges. So some people can get defensive. I mean, there's a variety of things, you know. No is one of those words that you really don't know what's going to happen to the person on the other side when you say no. You know, what does that mean? Some people say, okay, fine, can I come back? And they're great with it. And some people, they just go ballistic. And anyway, so yeah, just don't burn bridges. You know, a lot of times, in fact, if you're still young, what I recommend is you go out and talk to investors and say, hey, I'm not really looking for money right now. We're a little young right now, but I'd love to come in and talk to you, what we're doing, get some insight. Can you help us? And most investors, surprisingly, aren't too opposed to doing that. You know, they come in, they talk to, this, you know, that kind of thing. So don't always think that to talk to an investor, you have to be looking for money now. A lot of times, just build a little relationship with them. So that when you do come, hey, remember me? We talked a while back. Oh yeah, I remember you. Sure, you know, come on in. You know, it can help. It's a long-term thing. Yeah.
So actually, back on the international question.
Okay.
If I'm targeting the product for overseas market,
Okay.
is it better off getting funding from overseas?
Can be. So from a strategic perspective, think of where are you going first and where are you located. If you're going to go over to China, let's say, then it's usually easier to find funding in China because you're probably going to have to put people in China to make this thing successful over there. Well, now the investors here are like, oh, well, heck, I'm going to invest in you. You're going to all leave the country. I may never see you again or my money. So international is still tricky. It's getting better. And there's organizations that are getting much better at doing that. I'm just starting to work with a company right now that wants to set up an incubator to allow anyone from anywhere to be able to go and fund on both sides of the water. But it's still tricky. A lot of investors still do that 100-mile circle and say, anything outside of this circle, I don't invest. But you just have to understand that and build a strategy and a plan to address that. Okay, so hopefully you get through the deep dive and you go to due diligence. The due diligence really, by definition, happens up here. What happens in this phase really is the term sheet negotiation, and this is when the investor starts spending money. So it'll cost an investor probably $20,000 to go through this, because that's where the legal fees start, and they start doing term sheets and negotiations and all those kind of things. Prior to that, it's just internal, and now they write up the term sheet that they're going to say, here's your term sheet, and you're going to go, whoa, I didn't like that, or I do like that. Okay, now we're going to take a break, let Mark come up and talk for a little bit. That was kind of a generic overview. What we're going to do after Mark gets done here in a few minutes, I'm going to come back and we're going to go through page by page, step by step, and talk about pitch decks and how to do what opportunities and all the stuff that go along with that, and getting your message and how to actually talk to investors and how to make it compelling. Okay, so one of the things I forgot to mention is everybody outside, grab one of my business cards out there, and I will give you everything that we have up here tonight. I'll send all the deck to you and everything. So I usually say that at the beginning, but I know everybody taking pictures, so let me find my clicker here. Okay, so we're going to wrap the rest of the evening up by going through talking about pitch decks. Talking about pitch decks and kind of how to put things together. Yeah, go ahead. Sure, go ahead. Okay.
About having foreign, having a team here or a team from a foreign country.
Okay.
What happened if 80% of your team is here, but they're foreign?
Well, that's fine. I mean, yeah, I mean, it doesn't matter as long as they're here. Because what investors look for is risk. Investors like to be able to drive and look at companies and just see what's going on, be able to come in and help, be able to participate, be able to just walk into the office and see how it looks. Do you guys look like a professional company? Is things getting done with my money? And they like that. And so when everybody's scattered all over the place, that's not there. The risk goes up. There's just complexities that go to it. So that's really the mindset of most investors still. But the world is becoming smaller. There's a lot more global stuff going on, though.
But is it easy to stay here, do a startup, as opposed to working for a big company that has to do the H-1B visa?
Well, now that's a different animal, whether you're here on a tech visa. I mean, the first startup I was in, I was the only citizen, U.S. citizen. All the C-level were Israeli, all the programmers were Indian, and all the QA were Russian. And I mean like right off the plane. So lunch was pretty interesting. And I was doing the business side of the house, so I was the only U.S. citizen, and everybody else were on tech visas, the entire company. So there's all sorts of ways to do that. But an H-1B and working for a company, that's probably easy, or getting your visa is probably the easiest way to, stay that being employed. It's more difficult as a startup because of the uncertainty that goes along with that employment opportunity.
The question is more about, you have leadership team who are in that category. Then what?
They have, but at the end of the day, if we think you're going to get on an airplane and leave, you're not going to get our money. So that's the idea behind roots. There has to be some roots here somewhere by somebody. If everyone's just visiting, then it's going to be hard for me to give you $1 million and go to your apartment and it's empty.
On the other hand, if your startup has received $2 million, the founders can get some kind of visa.
They can, if the founders gave you $2 million, they can probably buy a visa. Yep, they probably can. So your investors can do a lot of things for you. That's the advantage of having some of those folks. But yeah, that's a whole different complex story. That's more of internationalization and how to open a startup when we're not from here, or we have these kind of. That's a little different topic. But it's an important one though. Okay, pitch decks. So let's talk about that. So let's start off with a couple things. So the fundamental rules. So the pitch deck we're talking about today is what I call your baseline pitch deck. And there's a bunch of pitch decks you're going to create because your pitch needs to be geared to whoever you're pitching to. That's important. So we're going to develop what I call the baseline pitch deck, which means this pitch deck could stand on its own. That means if somebody was to, you're talking to somebody and you've already gone past the executive summary stage, you just spend 20 minutes talking about it, and they say, well, hey, send me your pitch deck. This is the pitch deck you would send them because they could read it, they could go, oh, I got it, I understand it, and it stands on its own. It's probably the pitch deck you would use in a formal environment where you're talking to Band of Angels or something in a more formal environment. But there's other pitches that have different purposes, whether you're like at F50 or any of the Y Combinator or any of these places that do the competitions where you're on a stage and you got some panelists who are going to vote for you and give you $25,000 in grand prize winning money tonight if you're the one selected. Those kind of pitches are done different. Those pitches are done with the nice big pictures and giant stuff, and it's all about you talking. Because you're never going to leave that pitch behind. So it's all about flash behind you while you're telling your story. The classic Guy Kawasaki, one word, big font, you know, all these kind of things. That pitch deck doesn't work in a formal environment where you give your pitch and they say, oh, can I get a soft copy of your pitch? Oh yeah, here you go. So now Friday I get my coffee and I'm going to read through the 22 pitch decks I got this week from companies, and I get to yours with all these nice big pictures, and I don't remember what the pitch was about. I can just see the pictures. So that pitch deck doesn't work in a formal environment, and if you use this pitch deck at a Y Combinator or an F50 competition, you're going to kill them because there's way too many bullets and too many lines. So you got to do it. So we start with this pitch deck because this is the one that you can do it. It tells your whole story. And then from there, you're going to take this pitch deck and tweak it to any particular person that you're talking to. If somebody's giving you some insight and says, oh, well, they like to always have the team first. Oh, no problem. Put the team up first. Now you've done their thing. So we're going to do that. So keep in mind of who you're presenting and so forth. And those are some of the things. So there's different pitches, and we're going to talk about the difference between the pitch and what you're saying. So first off, let's start with the beginning. You sell your product to customers. You sell your business case to investors. This pitch isn't about your product. It's about your business case. Is there a business case here that everybody can make money and looks like there's a reason to be talking? Okay? So you don't sell your product to customers. So you don't need to spend much time, hardly any time, talking about your product. When we go to the deep dive, if we have questions about your product, then we'll dig into it then. The purpose of this 10-minute pitch is to get you to the deep dive. So sell your business case. If they think there's money to be made, I guarantee they'll ask you to come back for the deep dive if they think you can do it. Okay, so that's one. Two, opportunity-based. Everything you're talking about should lead back to how you're going to capture the opportunity, which is big, and everybody wants it, and they want it now. Okay? The other thing we're going to talk about is simplicity and clarity. Your problem you're solving isn't a paragraph. The simplicity of things is amazing how quickly you can cut to the chase with your one little short item direct to the point. When CEOs sit down and have a meeting, you take two CEOs from a Fortune 100 company. They sit down and they decide to merger on a $20 billion deal. That meeting was probably 10 or 15 minutes. That's it. They agreed on the fundamental vision. They agreed on the high end. They agreed that there's value to work together. They shake hands. Now all that work's going to go out and it's going to roll down to everybody else who's going to spend the next 3.5 years making that 10-minute discussion come to reality. But CEOs don't spend a lot of time in the weeds. And you're not supposed to spend a lot of time in the weeds. The point is to get the key things across. And we're going to do that with simplicity and clarity. Know your audience. Are you talking to a formal group? Is it public like Y Combinator? Is it a one-on-one like we talked earlier? On a one-on-one, you may not pitch anything. You may just sit down and talk to them over lunch. But you need to have the pitch in your head. You have to understand it. You have to understand how to get that information out in an intelligible manner so that we can all understand it. And sometimes if you're in public and in group environments now, the laws have changed. So now if you're out front, you can't ask for money anymore in a room full of people unless you know they're all investors, because that's now illegal. In fact, if you're going to have a discussion in a room full of people and you want to come, in theory, you're supposed to notify them and they have to provide financials and prove that they're an accredited investor before they get there, before you're allowed to talk to them. And if any of that stuff doesn't happen and you get caught and you did all these things, you could be banned by the SEC from looking for funding for 12 months. Now, that is all weird. And so that whole jobs bill is all starting to shake out and there's all sorts of weird stuff going on. So the industry is changing as we speak. There's a lot of things that you could do that now you can do, and things you used to be able to do and now you can't. But anyway, so it makes a difference whether you're, what kind of environment you're in, on what kind of pitch you're going to give, and who you're going to do it, and how it's going to happen. Now, we're going to talk about two things. The presentation. We're going to talk about the pitch deck. The pitch deck's purpose in life is to present your information in the way you want it presented. Okay? Do not confuse the pitch deck with the pitch. The pitch, or the story, is a compelling, passionate, engaging story that you're telling along with your pitch deck. Okay? If you're doing this really well and you're really good and comfortable up front, then the story you're telling probably uses none of the words that are on your pitch deck. What you're going to do is, because we can read your pitch deck, we know what your pitch deck says. So we're going to read your pitch deck and get the facts that you want us to get from your pitch deck. But now you're going to tell us a compelling story and wrap a story around those facts that give us an interesting dialogue. Oh, well, I started this because back in the day when I did this, I had trouble doing that, and we got to this. And so you're going to tell this compelling story. Now, this gets another one of those unfair things that the industry has done, in my opinion, is they like it, somehow or another, everybody's convinced that you need to show up like Steve Jobs and tell your story and be compelling and all this good stuff. Most people aren't that. So it takes a lot of work and a lot of coaching to be able to get there. I just had a painful meeting I sat through where the guy actually read every word on his deck. I haven't seen that in years. Most people aren't that bad, but all they do is regurgitate what's on the deck. You know, they just say it in a slightly different spin. Well, we can read your deck. So you're better off if you can tell me a story that the facts are on your deck and the compelling, interesting part is what's coming out of your mouth. That's magic. That's how it really happens. And that's not for everyone to do, but it's amazing when that happens. So do not confuse these two. So build your pitch deck that states the facts the way you want, then come up with a compelling story to wrap around that so that it's interesting for that 10 minutes. All right, let's talk about the slide deck now. Oh, question. Yep, go ahead.
Coming back a little bit, so when you set up the executive summary, do you think the executive summary is just content, like words, or should you throw in some numbers and some pictures?
Oh, we love numbers. So here's what I don't want to see. I don't want to see an entire page of solid words and sentences in 3-point font. One, because I'm getting older and I can't read 3-point font anymore. I'm not sure I ever could. But anyway, I get those all the time. So the idea isn't to jam more on. Never go below 11 font. Stay at 11. And be direct to the point and so forth. And if you've done your pitch deck correctly, you can just cut and paste that out of there and your executive summary it'll ring. So you want some pictures. We love numbers. All about metrics. Numbers add validation and make you look like you know what you're talking about and so forth. But we'll talk a little bit about that. But that's a good question, though. But it's a little bit of everything. It's a compelling. Keep in mind, it's your resume. And I'm going to read. I spend 10 seconds on an executive summary. If it hasn't captured my interest in 10 seconds, I move on to the next one, just like a resume. And we'll talk about that here in a second. Okay, so let's talk about what's important here. So your very first, so on the very first slide you're going to do after your fancy title slide with all your taglines and all the impressive stuff on it, is we're going to start with the very first slide is opportunity. We are not starting with the problem because I don't want to know about the problem yet. I don't even know what the opportunity is. I don't know what sandbox we're standing in, so don't hit me with a problem before I understand what's going on in the big picture. So we're going to start with the opportunity. The opportunity is why are we here? That's the main thing. And then keep in mind, investors invest in opportunities. This opportunity slide is the one that allows you to get your hooks in it. If you've done a good enough job to convince the investor that you know this train's leaving the station, you're either going to get on board now or you're gone. So it's critical to sell them the opportunity. If you've done a good job on this slide, they're going to be just dying to hear what you have to say because they already like the opportunity. It's big, it's moving fast, it's growing at 400% a year, and yada yada. So I definitely don't want to miss this. Now, if you do a really good job of convincing me that the opportunity is big, everybody wants it, they want it now, then my next logical question to you is going to be, well, if it's such a great opportunity, why isn't everybody doing it? Logical answer. Okay, and now that's the problem you're going to solve. You're going to explain to me, well, why isn't everybody doing it? Oh, well, they're not doing it because, and the button doesn't work. There it is. Because of this. Now, most people think of the problem and they'll say, oh, well, my product does this, therefore my problem is going to be this. This problem has to be strategic. One line, just one line, maybe two if it's a lot, but 1 to 2 lines, strategic in nature. If I read your problem, it should be absolutely obvious that if you solve that, you're going to make some money. Not solving that problem fixes some tactical thing that's complicated. Well, oh, how do you find somebody to do something that's right next door to you and I can't find them, so I'm going to create this proximity app that says I can find somebody next door to me to play soccer whenever I want. Great. How do you make money? Where's the opportunity? How do you make money? You know, finding somebody to play soccer when I can't find them, is that a problem? Absolutely. Can you make money at that? Possibly. But you've got to start with how you make money. So we're going to start with the opportunity and the problem. You're going to show me exactly how that problem can capture that opportunity. Yes?
I wonder what Snapchat slide deck is.
Huh?
I wonder what Snapchat slide deck
You know, it's interesting because in a lot of situations, you know, everybody says you have to be solving a problem. And a lot of these folks didn't really solve any real problems. They created a solution where there really wasn't even a problem there. But then all of a sudden they became a multi-million-dollar company because someone valued them at a huge chunk of money. You know, so did I really need to know I needed my emails or my text to disappear? I didn't even know I had a problem with that. You know? So anyway, so it's a tricky thing. At the end of the day, you're going to find in this environment that you talk to 5 or 6 people on how to do something and how this goes and how it works, and you'll get 5 different responses. In fact, if you go ask that same person 3 weeks later, they'll probably give you a different answer than they gave you the first time. Because it's kind of like wine. You know, everybody's got their thought of why this is good and why it's good, and it tasted good today, but now tomorrow that wine doesn't taste as good as it did last week when I bought it. So investors are very similar to this. What we're trying to do is focus on the fundamentals that will work with every investor across every board, and you're always going to find investors. You'll get to that when you start doing things like charts and tables. So if you do an investor chart and you do the classic, here's the table, here's all my competitors, here's all the feature sets, you notice we're all yes and they're all no, so we're better. Okay, you show that, you're having investors goes, I hate that chart. That's the most stupid chart. I never want to see it on those charts. Those are lame charts. You go, oh, okay. Well, we're going to do it like this in a quad chart, which has a much more depth, provides all this angle. I go, oh yeah, I hate those charts. So no matter what chart you pick, there's probably someone in the room that doesn't like the chart you picked. Okay, so when you get down to some of these details, stay focused on the message and don't get too wrapped up in whether the person likes this chart or these kind of things. But understand how you're going through and understanding the strategic value of each one of these pages and make each one of these pages a home run. Okay? So problem. Obviously your solution is going to say the problem says it's broken, your solution says we fix it. Okay? So there's 2 parts of your solution. One is you solve the problems, and 2, why you. Don't just tell me you solve the problems. You got to let me know why you, what's important about you. And normally we don't care about features. Now the market. Who are you? Where do you fit? What are the dynamics? Market dynamics can be huge. So the example I told you earlier about the guys that put the kit on the pickup and converted it into a hybrid truck. Okay, when I first started working with them, our message was all about the fact that they can double the gas mileage of any pickup. So their Ford F-150 gets 45 miles per gallon. Well, that was great when gas was $4 a gallon. Well, then in January, they called me up and said, hey, Gary, we got to change our message. This save gas mileage isn't working anymore because now gas is $2.85 and nobody cares anymore. So I came back in, and what we decided was to go to a utility. We changed their message from being gas savings to utility because by default, they have a 37 kW generator in the back of their truck full of batteries that run their electric system. So now we sell them a utility. They've got the generator, they've got the horsepower. Oh, by the way, their 45 mile per gallon F-150 has 700 horsepower. So they got the horsepower, the towing, the gas mileage, a 35 kW generator in the back. Well, heck, now they got all sorts of utility that's with every truck. That if PG&E does that, they got to buy a $30,000 generator to drag behind them. They got to buy a diesel to get that kind of horsepower. So now they've got all these things. So it became about utility. Oh, and by the way, we can double your gas mileage. So the dynamics in the market changed completely. So their entire story about savings gas was nobody cares anymore. It's $2.85 a gallon. It's not $4 anymore. Okay. So dynamics can be critical. Understanding that. Now we're going to get to the plan. And your plan, yeah.
Question about the market.
Yeah.
What if your offering is one that can serve a whole bunch of different markets?
Okay.
All very viable.
Mm-hmm.
You want to go after them, but you start with one.
Right.
Knock that one off. So how do you walk the line between showing potential? The potential is this first market, and then onward there's
Okay.
these other markets like.
Market segmentation. So you've got a pie, bunch of slices in it. Okay, you're going to start with this pie, and then you're going to go to this one, then to this one, to this one, and eventually you're going to have the whole pie. So how do you eat an elephant? How's an ant eat an elephant? One step at a time, one bite at a time. So you start off. Now, the question, then the next logical question is, well, why did you start with this segment? And that's either one of 2 things. 1, because it's the largest segment, or 2, in most cases, because your team understands that segment. And your team's more in line with that segment. They can start there, they can get it, they can learn the industry while they're going out because they know this one, and then they'll move to the others. So you're right. On one hand, you also have what I refer to as an application-rich product. So what happens in a lot of those cases is the entrepreneurs fail by trying to tell us all the things it could do. And at the end of the day, we say, well, that's great. What are you going to do? Okay, and so that becomes your plan. And so your plan might say, we're going to start with this segment, and then we're going to go to this segment, then we're going to go to these 5 segments, and somewhere down the road, we're going to have the whole pie. Because you don't want to say that you're going to start off with the pie at the beginning, because that's not believable. The risk would be too hard to do. So that's how you do it. You just sort of map it out and show how you're going to do it in your plan.
Even if it's like really technically 5 different pies. You know,
Could be that too.
it's not
Could be that
like we're
too.
gonna start in the Ford F-150 market, and we're going to go with the tiny rental companies and the medium rental companies and the large rental companies, like Ford F-150, Caterpillar,
Sure.
Plows, or whatever.
It could be. It could be. It just has to be. You just need to tie that together in your plan so it's credible, understandable. There's nothing wrong with that. In fact, that shows potential larger revenue streams. And problem with a lot of companies today is they have one revenue stream. And most people in the old days, you always like to have 2 or 3 or 4 revenue streams. That was always kind of the thing. Don't put all your eggs in one revenue stream. So all of a sudden, that revenue stream is struggling because of a market dynamic. So what do you do now?
So you don't think it's a risk to show this wide variety?
No, no.
It's not a risk of you're not so focused. You gotta.
No, that's where your plan comes in. Your plan. We'll go through that here in a second. Okay, so now we talked about the team. What's also important on your team that someone mentioned earlier is when you tell me what's on your team, tell me what's not on your team. What are you missing? Because if you don't tell me you're missing anybody, then we may look at your team, and our assumption may be that you think you have everything, and I'm looking here at a screaming hole in the middle of your team, yet you're not telling me you have any holes in your team. So our assumption is you think you have everything, and now you're losing credibility again because it's obvious you don't. And in fact, this is the perfect opportunity for you to tell the investor, hey, I'm looking for a chief marketing officer in these particular verticals. Can you help us fill this spot? Because you're interviewing the investor just as much as they're interviewing you. There's a couple areas they can help you. 1, can they help you fill the spots on the team? 2, can they carry you to your next round of funding if you go and get funded with them? If the answer to both of those are no, then I would ask them, why am I wasting my time with you? You can't do anything for me. You can't bring me anything to the team other than write me a check. Now, if the pen's sitting on the check, it's really hard to push back. When you can see it right there, you might say, well, I'm good with that other stuff. I just want the money. But anyway, so look for those things. Yeah. It does not. It can allow you to go up in flames in higher style, though. Yeah.
So if your main developer is being outsourced,
Okay.
but he would consider the possibility of joining the team full-time if he wants to come.
Okay.
Does it make sense to put him
Absolutely. Take credit for everybody you can. Because you're going to have most of the people are going to probably say, hey, as soon as you can pay me, I'm on board. So you're going to have a lot of folks like that. So we just put them on the team that they're committed. They're on the team. Soon as funding, these guys come up. Here's what they're going to do. Here's the positions. Then they're there. Yeah.
So going back to the question about market, do you look by the total number of users who are signed up throughout the US, or would you even be more focused to say, okay, you started over here in the Bay Area, what are the number of users in the Bay Area? Where should the focus be?
Well, that's a good question. So a lot of people like to stand up and say, hey, we just started our product. We're here in the Bay Area. We've boom, 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 boom. We've got 5,000 people in the Bay Area as early adopters. The Bay Area is by no means representative of the rest of the world. We are natural early adopters. It doesn't matter what it is. We just are. I can guarantee you got 5,000 people here. That's not going to happen in Tulsa. It's different. So a lot of people come up and try to use the Bay Area as their measuring stick that says, hey, look how popular we are. Look at these early adopters. It's like going to a Ford dealer and go, wow, everybody here drives a Ford. This is cool. Well, really? So anyway, so it's tricky on that whole early adopter thing and what's a real valuable early adopters and just a group full of people that are really popular, like this valley. So it's different. But we'll talk a little bit about the early adopter thing and how that works because it's critical to do it. So certain models now in the software world aren't necessarily geared around revenue. They're just geared around getting a lot of bodies on the platform. Still trying to figure out how those are going to work out in the long run because at the end of the day, you have to make money. But there's different models for different things, and if you understand your space and how to build that up and how to show that in your plan, all good. But there's different things to do that. Okay, financials. The next slide then after the team is the financials. How do you make money? It is amazing how many pitches I go through and they never tell us how they make money. Well, we're making lots of it. Well, how do you make money? You know, and so, and then we get a lot of times, well, you know, we're a new breaking software thing. We haven't quite figured that out. We're going to play the market for a while and let it run and see where we make money, which is what Facebook did. That's what Twitter did. That's what a lot of those folks that come out with the very first one. They said, we're not really sure how we're going to make money, but we got 1 billion people on our platform. I'm sure we can make money. You know, so that's kind of how that mentality set in, and some of the internet's still kind of like that. Of course, a lot of people like on Twitter now are getting really nervous because that's been out there for a while now, and that whole monetizing thing's not really happening yet. So they're getting nervous. But anyway, okay, now let's go and dive through the pitch deck. So you got your title page here. We're going to go through this. We're getting close on time here. So we're going to hit you with stuff. Ask me some questions, because here we're going to get through the real details of putting your pitch deck. So here's what I want everybody to think of, is this sentence right here. This is your vision. The future of whatever it is you're doing is what? Okay? So I helped launch a woman who had a hydroponics greenhouse, commercial level hydroponics greenhouse. Nothing special there. So we spent a lot of time to find out. And this is your why. This also is what will help you build a team. Why do you do this, and why is it important? So what it turned out with her was that by the time we went through a few things, we found out the real reason she does this, and her vision is that the future of agriculture is grow local, consume local. The idea of growing everything in Salinas and shipping it all over the world and letting it ripen in the back of trucks is old school. You know, build a greenhouse, put it right here, pick it off. The restaurant has it on by 10 o'clock in the morning. Every restaurant in town's got fresh veggies on their salads. So that's her concept. Grow local, consume local, and that's a big push. A lot of people believe that. It used to be called farm to table in the old days, but now it's grow local, consume local. And the farmers markets are starting to go down that route. So think of this, the future of what is what, because that's your vision statement. And that should represent your vision of where you believe the future's at and where you're going. And it should, when you make that statement, we believe the future of so-and-so is this. Then it leads you into the natural next step. And here's why we believe the future is this. We believe it's this because blah, 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 blah. And now you walk right into the opportunity. Why? We believe the future because of smartphones, because of mobile, because of this, because everybody wants it, because of 83 millennials that can't do that stuff anymore if it's not on their phone, and these kind of things. So these are the reasons why you're doing it. So what we're going to do first is you're going to give me a statement right at the top. We are in the $82 billion widget market, okay? By making that one statement and identifying what you're doing. So let me ask you a question. What space are your 5 pies in? What would you say is the one thing that makes you that? If I was to ask you that question, what market are you in?
Weight loss.
Weight loss, okay.
That's 1 pie.
That's 1 pie. Okay, give me another pie.
Corporate training.
Okay. Jumping through hoops? Weight loss? Corporate training? Putting out fires?
It's actually not
Oh.
weight loss in the corporate.
Oh,
It's
okay.
team performance.
Okay, so now you confuse me. So what's the one common thread?
Brain training.
Okay. So now, start defining it from that perspective. Because what this does at the very beginning is it tells me what sandbox you're in. Once I know what sandbox you're in, I can start formulating all my own ideas because I know what sandbox you're in. I may not know how you play in that sandbox, but I know you're in the social market. You're in the brain training market. You're in the whatever. Make that a clear, simple, because as soon as I know what that is, boom. Now, this isn't your target market or anything. This is a big number that says, here's this market that we're in. We're in this sandbox. And it's big. It's $280 billion, okay? We're in the $280 billion whatever market, okay? Now, I know what sandbox you're in, and I can start framing my ideas on that. Now, your next step is to tell me, why is that big market an opportunity? Why is it an opportunity? Because it's going to grow by some huge amount. There has to be growth. If you're in a dying market, probably not an opportunity. If your product is focused on the baby boomers, get them quick, they're dying. It's only a short market. So most of your stuff should be focusing on millennials and things like that. So make sure that you're in a growing market. Everybody wants it. They want it now. They're willing to pay big money for it. Give me some stats on that. You know, especially things around. So I worked with a startup. I worked with a company that makes Bluetooth speakers and a little floating Bluetooth speaker. Got him $1 million on a Kickstarter campaign and stuff. And so one of the things in the process of doing that was one of the statistics that supported his industry is the fact that, one, millennials, 80% of millennials say they cannot get through a day without listening to music on their phone, period. Good stat. Everybody, 80% of the people out there want it. Okay, that's a good number. So these are the kind of things that show those things in demand. by reference, there are 83 million millennials in the United States right now, just for reference. It was, and so the things you're looking for, trends, market dynamics, demand, growth. This can be a good place sometimes to show some use cases. Another thing that works good on here to set it up is if there's a startup in your space that just got a big funding, like, hey, you know, so-and-so just got $82 million in funding. Well, then that validates another reason for opportunity, because there's other investors that think this is a hot area, and the last thing investors want is to be left behind. You know, so if there's other people investing in this and it's hot and you've got all these, so at the end of the day, you're Rembrandt. You're gonna paint this to where I'm done. It's like, oh my God, we got to get on this. This is amazing. This is an opportunity. We got to do this. I can't miss this. Then you're going to come back to that question. Okay, so why isn't everybody doing it? Now you're going to give me a problem, and I always find it interesting because not everybody solves a problem. And people say, well, if you're not solving a problem, then you can't make big money. You can't have an impact. Pick any of the top 3 video games now today when they come out. In one weekend, they sell $1 billion. One weekend, they solve no problems. Huge investment money. I mean, huge, no problem solved. But they do solve a demand. So you need to be solving a problem or a desire. If you're solving a problem or a desire, you can probably make money. I can guarantee that new Corvettes don't solve any problems. But they do fit that desire. I got to have one of those, you know. So anyway, think about that. Now, the key, though, is to turn around and spin it into a problem so that it looks like you're fitting the mold that the investor wants to see. So pick the right problem. And the right problem is the one that your solution solves the best from a strategic view. Keep in mind, you get to pick the problem. So many people just seem to pull a problem out of the air and say, oh, we solved this problem. That's a lame problem to solve. So one single strategic problem. And it has to be simple terms. This is broken. And you want it to be really clear and concise on what that statement is. There's a little bit of this art to doing all these. There's to bringing it down and dialing it in. So when I read your problem, it has to be obvious that if you fix this, we can make money. Look at what you solve best and try to determine how to pull that up and scale it up. Normally what's going to happen when I look at this, I see 4 or 5 bullets. Here's the problems we solve. What I'll tell you to do is take those 4 or 5 bullets, group them together, and tell me what one problem those all have in common, like I was doing with you. What's the one common problem they have? That's the problem they have. Those little tactical bullets underneath it now validate that that big bullet's real, and they give you real tactical examples of why that big problem is real. But solving tactical problems rarely dials you into a VC fundable opportunity. You just have to so most of what startups that I work with on one-on-one, part of what we do on these pages is elevate them to a more strategic level and get out of the weeds. So once you've identified your one problem, you may have a variety of supporting qualifying statements down here like, oh, it's expensive, it takes a long time, technology wasn't there, here's some use cases of why these problems all exist. But these become qualifying or examples of your big problem. Now, when I get to the solution, you're going to solve the problem in the exact same way. So you're going to have how we solve the problem. If I had cost, time, and quality, then on my solution page, I'm going to have cost, time, and quality, and how I fix each one of those problems in that order. Don't make us dig between, well, here's the problems, and here's some solutions to totally different problems. Don't make us have to put those together. So you want to walk us through real simple. Here's the problems. Here's how we solve them. Now, that's only half of it. Once you've told me you solve the problem, I need to understand what you do and why you're better and what about you. And this isn't just about why your product's better. For example, Uber. We'll use Uber again since somebody brought it up as an example. If Uber came up, they didn't make a better car, they didn't make a better taxi, they didn't make better anything. They came out simply with a model. So when you come over here, you're going to say, we have a unique model that does this.
It's a better service.
That could be arguable. But I've used Uber and got worse service than any taxi. But they're individual, they're independent. Most of the services have been good. But to guarantee that it's a better service, I would say you're stepping in a deep pool there.
Come to the middle of Manhattan on a rainy day and tell me how the taxi cab service is in New York.
Well, I don't go to Manhattan. I go to New York, so I'll let you have that one. Yeah, but I've done the same thing. I've had Uber never show up at all. I sat there for an hour for them, and they never showed up at all. And I had 32 taxis go by me. I finally gave up and flagged a taxi. Yeah. Oh, there you go. So anyway, so over here, tell me why you're different. It may be your model. It may be your product. It may be a variety of things. But don't just focus on why you're better because of your features. It's rarely about features. The innovation highway is littered with a lot of better products that got beat by lesser products. So it's not, and it's never about features. If I'm buying your product, it's about features. Anyway, so don't get too focused on the product when you're thinking about why you and what makes you better, okay? The other thing you'll notice I say here is competitor landscape axis, because we're going to talk about that in a second here. So now that you've done this, now the solution, the problem, and the opportunity have to be worked in together. They have to be choreographed very well together, because that's one area that you get to pick everything about that. So make it right, make it choreographed together so it's very obvious how the opportunity, the problem, the solution fit together. Now we're going to talk about the market a little bit and get to that other thing. So now, opportunity and market are very similar, and people confuse them all the time because frequently they fall under the same category. Sure, opportunity it's an opportunity because of the market. But we're going to break those into the two things. So most people think of marketing as things like brochures and putting stuff like that, and people tend to confuse marketing with PR and some of these other things. Yeah, they do brochures and they do marketing communications and they do shows. What marketing really does is they're supposed to do all the analysis that tells you what's going on in your market for the next 5 years, and they feed all that data to business development, and then business development turns all those numbers into a 5-year plan of where you're going to go, and then that flows down to the salespeople, and here's your quota for this year. So that's kind of how the big process works. So marketing's got a lot of stuff. We already talked about the opportunity. We've always showed you that it's big, it's growing, and so forth. So now on this page, what I want to know is when we leave this page, I want to understand that you know what sandbox you're standing in. You know the players in your sandbox. You know what's going on and the dynamics in your sandbox. You know how to get along and coexist with the people in your sandbox. And you know how you're going to own the sandbox when recess is over. Okay? So we want to understand. So you're going to do that by giving me a couple little bullets up here that have some compelling facts, some insight to your market. Not that it's growing, not that it's big, not that it's demanding, but some numbers that would let me know that you have an understanding of your market that might, like, oh, that was an interesting stat. I didn't know that. You know? You're like, well, did you know that 8 out of 9 people would prefer doing this over that? Wow, I never knew that stat. Has nothing to do with growing, has nothing to do with bigger, has nothing to do with opportunity. It provided me some insight that kind of validates your product a little bit within the market and gave me some insight that you're knowledgeable of that market. I don't need 9 or 10 of these. 2 is fine. You know, maybe 3 if you've got 3 really good ones. You know, but just a couple of them that give me some insight. Second thing we want to talk about is those 2 brothers, Tam and Sam. So are you guys familiar with those terms? So TAM is a target market and SAM is a serviceable market. Frequently they've got the triplet in there, which is SOM, which is an obtainable market. So if you go and look at out there, TAM is either a target applicable, target available, target addressable. It depends. But anyway, it's your target market. It fundamentally says that in my sandbox, my TAM says that everybody in this space, my TAM, everybody in my TAM could use my product. Are they all going to? Maybe not. Maybe this end and this end aren't likely, but they could. So my SAM is the sub-element of that target market, which I'm actually specifically going to focus on. Let's say, for example, I'm doing some new mobile thing, and I'm really focusing on the millennials, and I really think that the 18 to 30-year-olds will be the likely candidate to buy this. Does that mean a 65-year-old person couldn't buy it? Sure, they could, and they may be in my TAM, but I'm not advertising to that crowd. I'm not marketing to that crowd. I'm not reaching out to that crowd. I'm reaching out to my SAM. So define it as if everybody did it, I would get that. But we're going after this group here because we're going to focus on this particular target market underneath that. That might be US, it might be whatever, so forth. So that's kind of how the TAM and SAM work. Now, we're going to spend a little bit more time here on the competitive landscape. I myself, I like the quad chart for competitive landscape because it gives you more flexibility. The table where you've got all your competitors and the S's and the X's, and that's so old school. We're so tired of those. We know what it's going to say. You're going to have all the X's and your competitors aren't. And again, you're down to the feature level, so you're already losing the battle if we're talking features. So what we want to do here is stay at a very high strategic level. So for example, let's say you're creating a new product that's geared after certain particular people, and you're telling me about it, and my first thought is, wow, well, doesn't Google already do that? This kind of a chart could potentially allow you to line it up. It says, yeah, but Google's going after these people, and I'm going after these people. We're in the sandbox. We're going after different people, so we can easily coexist in here, okay? So this chart will allow you to do that. The things that you pick on these is really tricky and really critical. So what I normally say, identify the 2 things that are you think you do the best and are uniquely different to you, or unique enough that separates you. And then when you're done, you want to label these so that you end up kind of up in this upper right-hand corner. Now, the reason you do that is just because of the good old school system. They've all trained us that this is bad down here, and upper right hand, you know, all the good stuff goes up to the right, you know. All the bad stuff goes the other way. It has no bearing on this chart, but either way, it still comes out the same way. It's psychological. So you want to be up here. So you want to pick this. These are sliding scales. So let's say you're automated, and this would be manual. So if your process is extremely automated, and if this one here is, I don't know, low dollar, you know, this is, you know, cheap and this is expensive, you're very low cost and very automated, then you're here. If your model and everybody else still operates in a manual mode and they're expensive, they could be over here. So what you can do now is you can identify people based on a couple different parameters, not features, and you can actually do a third parameter and give it a 3D effect by adding color coding. So it may be that this actually does everything perfect for you, but there's a third feature that you're really unique in. And some people do it, some don't, but nobody does both of them like you do. Then you can do that with color coding and actually have 3 different measure bases on here. And this is critical. Once you've identified those and you've started plugging all your companies on there, whether you're using their logos or whatever, this is critical to do this in animation. You've got to have animation. Because what happens is if you click and all of a sudden this is loaded with all sorts of companies, you're going to try to talk about it, and an investor is going to be in the room trying to read these axes and look at the companies and say, well, why do they have them over there, and why is, and you're going to lose the audience. So one of the areas that most people really suffer is in the competitive environment. Because when you're doing your comparison, everybody does on a feature, so it doesn't matter. And so the other thing that happens is we as investors and everybody, we think we understand spaces, and we arrive at our own conclusions very easily. If you just slap that up there and you show me what's up there, I'm going to arrive at my own conclusions, and you're going to go, you're not different. Okay? So what you're going to do here in animation is you're going to walk them down the road holding their hands exactly where you want to see it. In most markets, you have 3 types of competitors. You have the incumbent, the big boys. They've been there forever. General Electric, you know, Maytag, you know, medical, pick a number. You know, these big companies have been there forever. They've been doing it a long time. They do the services you're offering today, but you're doing it better, more, whatever. But they've been there forever. You can't ignore them because they're there. And they are absolutely a competitor. So you're going to start with those competitors. The second type of competitor you have is what I refer to as the now generation. The companies that are out there now. So you might have the Googles, which were the old school guys, been around forever. Now you got the new generation that might be in your space, maybe the Snapchats or the Foursquares, or pick somebody that's kind of in this space, that's kind of the new wave person. They've got some traction, they're making some money, people know who they are, but they're considered kind of the new kids on the block. Then you got the third competitor, which are all of you sitting in this room that all have an idea, who are all in the same space, who are actually more likely to be the real competitors of you because these other companies are already way down the road, and you may be going after different markets, you may be doing things different. They're in your sandbox, but not as a direct competitor as the person potentially sitting right next to you building the same product at the same time, okay? So as you walk through these, you can easily walk through with your clicker and say, okay, we believe that in the market space, our market space is defined by these primary metrics right here. So, you know, automated, manually, automated, and cost, and yada, yada, yada. These are what drive this space. You hit click again. Now, you all know the big boys out here, the Googles, the Yahoos, the Apples. They've been doing this for a long time, and so those guys pop up wherever they pop up. You talk about that, and you say, and now we've got this next group of people where the industry has kind of moved along, and they've come along this way, click. Now you have the next generation of peoples out here, the Androids, the Samsungs, the whatever, yada, 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 who are in this space now. Click, and now we have this new group of people which are kind of doing this, this, and this, and moving along, and that's kind of where that sits. And then click, now you pop up. And so now here's how we fit in that space. Boom, boom, boom. Now you've walked them through it, and they hopefully will arrive at the competitive environment looking at it the same way you see it. If you allow them to just look and arrive at their conclusion, they're going to come at whatever conclusion they come at. But if you can walk them down through here, when you're done, they fully understand now how you fit in the sandbox, how you get along with people, and people that they might have initially thought, well, gee, I really thought they were a competitor, but I can see they're going after this space over here, which is completely different than what you're doing. So, oh, okay, I see how that fits. You can go through so much more power on this kind of a chart and talk to it like a CEO and stay very high level and understand all the aspects, your product, your business, your models. All that can feed into why this is. The critical is picking the right labels for your axes there, okay? Now, once you're done with this, I know how you fit. Now we're going to get into the plan, and this is the nest big. So in a plan, this is a great way to do your plan. There's 3 things that happen in a plan. There's 3 milestones: product development, go-to-market, and growth. You can't leave this milestone until you have an MVP or a prototype. And like we said earlier, you notice this says completed with a check mark, because now we expect you to show up with that milestone done. Now, one of you had an expensive project you're working on which needs to get funded to get out of that, and that happens too. You can still do that. It's not impossible, and it happens all the time. But today's standard says you're going to show up with these things completed. So you're going to give me a list of what you did. You may not have anything there. You built your product. You got an executive team. Every one of these milestones have 3 business units I want to understand: business development, product development, and operations. Okay? Normally what I see is somebody gives me a really good job that says, hey, we're building a product, we're going to do an alpha, then we're going to do a beta, then we're going to do an MVP, then we're going to launch. And I like, that is so not a plan. And that's normally what I see when I see hardware, see stuff. They give me a little bit of a idea of what their product's going to do. Here, I want to understand what you're doing here. How much money did you spend to accomplish this? Through sweat equity, investor money, did friends and family give you money? What's that total? So here it might be, we got 550K skin in the game. 200,000 is investment and 350,000 is sweat equity from our team that's been working free for a year. Okay? So now I see what you skin in the game. Oh, and it so happens you're asking about the same amount. That's reasonable. So if you've got $1 here, they're going to be really nervous to give you 550K. But if you've spent 550, then you're just matching funds. That's a lot easier for an investor to look at. Says, hey, there's some commitment there. I can see where these guys can hang around. Yeah.
Is my time spent when you convert into numbers in the first section?
Yes. Yep. Now, financial money and funded money, the cash. Cash is always really simple and clean because they gave you 30, it's 30. When you start telling me that your sweat equity was 120K, I said, well, how'd you arrive at that? Well, I get 150K a year, and I've been working about 14 months. You know, I figure it's about 120K. And we say, yeah, but in a startup, you never get street value. You're only going to get 50K, so I think your sweat equity is only like 50K. So the sweat equity gets a little iffy, but as long as it's reasonable and so forth, it's fine. But make sure they understand how much of that was cash and how much was sweat equity. Now, you've built your product, you got an MVP, you're ready to go out. Angels will generally fund this milestone. It tends to be a relatively manageable amount of money, and really all you're doing is taking your product here, which you think is the product the customer wants, and you're going to put it out here, and you're going to put it in the hands of 12,000 users who are going to spend 12 months giving you feedback, and when you get done with this milestone at 16, you now have the product the customer wants at the price they're willing to pay because you validated all that for the last 12 months. Here, you just think you have what they want. Now here you may have some key features you're going to add to it, and it may just say that you're going to scale your product. Okay? Here you're going to definitely start growing. You'll notice there's a lot of numbers here. Don't say we're going to get users. How many users? Don't tell me you're going to have some blogger relationships. How many blogger relationships? How many of these that? So use numbers. These all add credibility. If you say, hey, we're going to have some partnerships. How many partnerships? That's not a plan. Here it's a plan. I know that it's this for 550 days. So if you're telling me that for 550K, you're going to come out of here with 170,000 in revenue, 12,000 users, 100 bloggers, 10,000 Kickstarter program, 50 affiliates, yada, yada, yada. All these things are going to be done. You're going to have your automated system, server, office, and team, and yada. So I know what you're going to spend my money on by TL. I look at that and say, okay, that seems reasonable. Now, when you got that done, now you're going to go to the next phase. You're going to grow, and you're going to scale everything. You're probably just going to scale. And then you're going to get to the finish line. And there's that finish line. 12, 36 months. We're saying that within 36 months, we're probably looking at an acquisition in this plan. Will it happen in 36? Don't know. Nobody knows for sure. But that's our plan. We're going to do this and we're going to do this. If you pay for that, we'll do that. You pay for that, it's going to take us to 60 million in revenue, and we believe we can be acquired at that point. Okay? So now as an investor, I know what your funding strategy is. I know where all the money's going. We can choose to say, why don't you pull that here? Or does that have to be done here? That seems risky. Well, we could push it over there. Fine, whatever. We can have a detailed discussion on what you're going to do, how you're going to do it. I know where the finish line is. I know that at 18 we're looking at something happening. So now I can see the whole thing from where I come in to where I potentially could get out, and I understand it a little bit in detail. And you've got a plan that says, wow, this looks like a plan. It looks like it could be executable. I like it. These guys look real. Then the next question, oh man, okay, go ahead.
So the business development, the first one after the 12 months we're talking about, let's say 177K revenue.
Right.
Versus the amount of money we're asking.
Right.
What is the ratio, relationship?
Doesn't matter. The purpose of this, the purpose here is not to make money. The purpose here is to validate my product and my model. I'm going to make a little money because odds are you're going to be throwing early adopter programs in there. You're going to give it away free. You're going to give people a cheap discount. You're going to do early adopter programs. That's where people get confused. The purpose of this phase is not to make money. If you make zero money, that's probably acceptable. You're going to make some money because you're going to be doing it for 12 months with 12,000 people doing stuff. So instead of charging them a $10 fee, you may say, hey, as an early adopter, come on board for 6 months, and then 6 months we'll charge you. So you're going to have early adopter programs. Keep in mind, that's where most people fail. You're going to make money here, and revenue's nice, but you need to validate your product. You'll be surprised when you think you've got the perfect product here. These people will come out here, and the first thing they're going to tell you, well, I don't like the color green you chose. What do you mean the color green? What is that? Well, I'm not going to buy it. It's green. Okay, so these are the stupid little things you're going to get from that 12 months of things that people are going to tell you. You got to take all that in, and the ones that are important, you got to incorporate it in your product so you have the right product. That's the purpose of this phase. And that's what investors, angels, pay for. And if you've done that right, then everybody knows that you're going to go here and you're going to get that money because you're going to be able to do that because you have the right product now. Yeah?
So the champions, like founders, quite small amount of money before getting the fund.
Doesn't mean anything. This is just your plan. This tells me what you think what you say you're going to do. Doesn't mean anything other than that. Other than this is what we're going to do. You may not have funders giving you any money there. Who knows? Yeah.
Do you know the source of the case studies on this phase, on companies who went to this phase and the kind of changes they did? And,
Here?
Yes.
Oh, yeah. So that little gap right there, that gap is called the chasm, based on the book that was written back in the 90s, Crossing the Chasm. If you all heard that, that's that famous chasm right there. Most companies die in this phase trying to get their product right and getting it to go to the next step. So a lot can happen in this phase. If you did really good homework, so if you follow lean, then you did all your homework up front, you know exactly what your customers want, and you built it. Now you're just going to go out and validate it, and hopefully it'll just be some tweaks. If you blew this phase, then you may have a whole lot of redesign going on here. It happens all the time. We used to call it re-engineering. Now it's called pivoting. But anyway, same thing. This is a critical area right here. That's why it needs to be long enough for you to incorporate the comments into your design and make the adjustments. So I have people come out here and say, oh, I'm going to do this for 3 months. I'm going to do a 3-month go-to-market plan. Well, how many comments are you going to get in and incorporate into your system in 3 months? Not many. You're pretty much going to go out here with the same product you had here, which is probably not the right product. And if you're going to go out into the software and you're going to roll it out to 50 people, that's probably not enough. If you're software, you need to be in the 10s or 20s or 30,000s. If you're hardware, that's a different story. You can put 4 or 5 prototypes out there or 3 prototypes or something, get the same kind of a thing. But you got to have enough people to feed it back and make sure you're doing the right thing. Yeah?
At which stage would you consider acceptable for the founders to self-assign a little stipend?
To themselves?
Yes.
Well, that is what the whole purpose of this is.
It became a work, like a job.
Yeah, that's the purpose of this. Everybody understands that in most cases, your startup money, the bulk of this is going to salaries. I mean, what else are your people doing? I mean, you have engineers that are designing a website. Okay, a website doesn't cost any money, relatively speaking. It's all the engineer designing it. Your sales and marketing people are going out and doing all this stuff up here, but you're paying it. So big chunks of that is actually salary. Although we don't say that. We'll talk about it here in a second. But at this point, it's assumed salaries are going to start. If you had the money to pay them back here, great. Probably didn't. But it's assumed at this point in time, people are going to start drawing salaries. And there was people that you had sitting on the side that said, I'll be there when you pay me. It's expected they show up that next morning when I give you the check, too. That the team's there and operating. It's not, oh, now we're going to go out and look for a team. Well, no, you told me you had a team. So anyway, does that answer your question? Yeah. Okay, now, talking about the team. Team, skills-based. Don't care where you worked. Skills-based, what have you done? It's all about skills. Are you qualified to be in the position? The other thing that's important, if you've done something before, like I said earlier, you can probably do it again. So tell me, use the word successfully a lot. Successfully led teams. Successfully did this. Successfully did those things. That's important. Success is critical. That eliminates a lot of risk. Just use the word successfully. I get a lot of times when people just say, and I'll give you a perfect example. Really good team I was working with about 2 years ago. One of the women on there who was in charge of their business group, when I was looking at their chart, she'd worked at Apple, Facebook, Google, Cisco, and where else did she work? A couple more other, Microsoft. And these were all potential customers that were in their customer base, which is why she was in charge of sales, because she had access to all these companies. So my initial thought was, so what'd you do at those companies? Were you in sales at all those companies? She, no, I was the receptionist. She'd be a receptionist at all those companies. Looked real impressive, but it didn't show me they had any skill qualification to be a sales rep. Now, the reality is she did have access to those, and it was fine to a certain degree. So understand successes, not where you've worked. Don't drop a bunch of names. Oh, I worked here, I went to school here, all these things. Those are nice, but at the end of the day, what has your team done, successfully done before, and show me that they're qualified to be your CFO, your CEO, your CTO, whatever. Success-based. Keep it around that. Now, if you're going to go talk to somebody like Stanford investors and stuff, and you went to Stanford, definitely put that on your, put the little Stanford down there. It helps. Okay. Okay. The other thing is, why will the staff? What are you missing? We talked about. Tell us what you're missing. If you're missing a salesperson, say I'm missing a salesperson. We're looking for a salesperson with this particular vertical skills with this, not a whole job description, but a little 1 or 2 liner that says this is what we're looking for. Then I know you don't have something, and I know you know exactly what you want. Again, you're building credibility, and then you can ask me if I have that for you. Oh, where'd I go here? Okay, we talked about the Moses factor already. Now you're going to get to financials. Now you've told me you have the team that's going to execute that great plan we just talked about. Now in the financials, tell me how you make money. Are you a subscription? Are you going to sell product? Are you advertising? How do you make money? And when we get down here, keep it simple. Don't make it an eye test. We're sitting in the back room. I don't need to know all your different this, that, and the others, and your EBITDA, and yada, yada, yada. Keep it simple. We're going to go back, and we're going to talk to you in a lot of detail. I just want to know the basics. Revenue, expenses, gross margin. In fact, you're not even going to tell me a single one of those dollar values. You're not even going to talk dollars at all in this chart. What you're going to talk to me about is customer acquisition. Customer acquisition is a number I can understand. If you say you're going to have 10 this month, and next year you're going to have 500, I could look at that and say, yeah, that sounds reasonable. If you tell me you're going to have 10 this month, and next year you're going to have 5 million, I might go, I'm not sure you can grow that fast. So now we can have a simple discussion on whether I agree with your growth. And you may have multiple types of customers. This customer may be a user that pays nothing. They're constantly going to be free. This may be a customer who's a business, who's the other half of your model, which is actually the one that's paying the revenues to belong. So this number is important because I want to see how you're going to grow to 10 million people out here, users, and have a big database. This shows me how your customer base is going to grow, and we're going to spend all our time talking about these numbers. Because my assumption is, you told me how you make money. Oh, you do a subscription at $4.99 a month. I know how you do it. If you've got 1 million people here, I can do the math. It's $4 million. So talk about customer acquisition and make sure that number is simple. This number down here is extremely complex. This number has revenues and expenses and efficiencies and mistakes and all sorts of stuff embedded in it. That's an extremely complex number. This one's not. I can do the math that says, so you're telling me if you meet these, then all these revenues match. Yes, they do. So don't talk about the dollars. Talk more about your customers, how you're going to grow them, and those kind of things. That make sense? We can read the chart. We're not going to believe that $200 million down here in 2019 anyway that you're telling us you're going to make by the third quarter. Anyway, so that's the finances. How do you make money? The other thing that can be good on this sometimes, if you've done things like customer acquisition costs, CAC, if you've done loan lifetime values, if you've cranked all the numbers, investors love metrics. The more you do metrics, the more you look like a big official company with numbers. Because when you go to a big official company, they've got all sorts of numbers. Numbers that you pull out, where did you get that number? Well, we're just good. We're Six Sigma. We can do that. So you want to leave that same impression. We have those numbers. We know what they are. Do you want to know what that is? Okay, if you've got those, kind of put them up here because investors like that kind of stuff. Okay, now we're getting to the funding. So at this point in time, if you haven't convinced me to invest in you, this chart's not going to do it. So all this is, in my opinion, is your summary chart. You've told me everything. You've told me what the opportunity is. You told me how you're going to capture that opportunity. You've convinced me that you have the right space in this market. You've shown me that you have a detailed plan that looks really impressive. And you've shown me a team that can execute that plan. So if I haven't bought yet, I'm not doing it on this chart. So this really becomes your summary chart. So now it's okay, Mr. Investor, Mrs. Investor. So I'd like to just, we're almost done here, so let's just wrap this up a little bit. We're looking for $550,000 to execute our milestone 1 go-to-market strategy, yada, yada. Or we're looking for $7 million based on the last chart to execute milestone 2 and milestone 3 growth. So if I'm talking to a VC, I want the $7 million. If I'm talking to an angel investor, I'm only looking for the $550 because I can't get the money anymore out of that. So tell me you want. And I just looked at your plan, so I know exactly how much money you want to execute your plan. Oh, okay, we looked at that. What I didn't get from you is how are you, I saw what all the tasks are going to do, where you're going to spend the money. What I don't know is what are you going to do with it. So now I'm going to give you the spread. Okay, so what we didn't talk about, let me show you how that money's spread. Right now, 60% is going to sales and marketing, 30% is going to go to product development, and 10% is going to go to operations. Okay? Those are the only 3 numbers you have on here. Product development, sales and marketing, and operations. We don't talk salaries. We don't talk individuals, because all you're doing right now is improving a product and selling it. That's all your company does. This little 10% here in operations, that's the necessary evil to do these 2, frequently referred to as overhead. So you have to have some people that does that. Well, guess what? Their salary's embedded all over this darn thing, but we just don't talk about it. So that's what we show them there. The next thing we're going to do is say, okay, so what does this buy? So all you're going to do now is you're going to go and summarize whichever milestone you're selling right now. Milestone 2 to the angel, or milestone 2 and 3 to a VC. If it's a VC, you're going to say it's going to take us this much revenue, this many customers, 15 patents, it's going to position us for acquisition. If you're talking to an angel investor, it's going to validate our product and our business model. It's going to bring us X number of customers. It's going to do some things. Whatever. Highlight the big things that come out of that. So now I know what, this is a summary chart. Then you're going to talk about your exit terms. You say, oh, by the way, we're offering up a 6.5% convertible note at 20%, yada, 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 whatever the case may be. Or we're offering up 10% straight up equity for whatever. So if you have your plan, then kind of put it in here. Then we know what it is. And then you say, and you can make checks payable to, and then you're done. Questions? Well, that was.
For teams is too young.
What's that?
Too young is not mature to build this kind of whole story.
Okay.
Do you think it's better to just give up the whole thing, or just continue to work with your team and evolve your ideas?
Keep going. Keep plugging away. Eventually, you'll be like me. You'll be old. You'll have gray. It'll come there. You'll get there. So let me talk about it. That's a good thing. So here's what I do. So for everybody that comes to my workshops, as Mark alluded to, I offer a one-on-one acceleration program for $600. There's nobody in this valley that does that. And I've got reasons for doing it. It's definitely not the $600. Although that's nice, but it's not for that. It allows me to work with you and so forth and determine how we can move you up. So I do one-on-one acceleration exactly the same way as F50 or Nest GSV or any of those folks do it. We just do it one-on-one. So what's going to happen is you guys decide you want to participate in this. Get my card, send me an email, tell me you want it. I'll send you my materials back. We'll sit down and we'll use whatever you have today for a pitch deck, because at the end of the day, that should be your business model. So we'll start with that. Our first meeting will be about 3.5 hours long. And we're going to go from one end of your business plan to the other end, which is going to be the pitch deck. And when we're done, you'll have a pitch deck drafted with holes in it. Normally the holes you're going to have is I'm going to tell you to go back and find more information and build your opportunity stronger. We're going to tweak a little bit on some of the problems. So we're going to probably spend a lot of time on the plan, because I make everybody squirm on the plan, because entrepreneurs do not know how to do a plan. They come up with this wavy thing, oh, we're going to do stuff. And so we're going to make you get that. So we spent about 3.5 hours working together, of which you're going to leave with a whole lot of homework and stuff to do. Then you're going to go do that, and you're going to send your updated deck back to me. I'm going to mark it up, and within 24 hours, we'll have another meeting. We don't have to get together on the second ones anymore. The first one we got to do together, if we can, because we cover a lot of territory. I mean, we do a lot in that 3.5 hours. After that, we can Skype or whatever the case, and I'll send you the marked up slides back. We'll go through it, really refine it a couple, 2 or 3 times. When that gets done and we've got all your messages and all your themes nailed down, they're clear, they're concise, your plan is solid, your everything is tightened up, then we'll cut and paste that into an executive summary, and you'll be ready to go. And then we'll take a look at my investment groups, and we'll see whether or not we can slide you up the ladder to my investor relations, get you out in front of some investors. We'll take a look at whether any other folks in my network can help you. Like, for example, if you need work with your models or whatever. So, for example, part of my GLJ group is Abbott, Stringham, and Lynch. We'll send you here, and maybe send you to Jeff. Jeff here will do your valuation for you. He'll help you determine what your valuation should be or what's reasonable for you. They may help you with your cost model. I may send you to some of my media guys, or you name it. I've got logistics in 190 countries. I've got engineering. I've got manufacturing. I've got HR. You name it. I've got somebody in my group. And we'll take through this process here. We'll find out where your gaps are, where we can maybe plug some people in to make you better. Maybe we can do some strategic partnerships that can help you grow. But we're going to sit down and accelerate you one-on-one. And I don't have a time frame to that, but it's $600, and we don't have, there's no window. It's not like 3 hours or whatever. We work until you're done. So it varies in length, and it varies from there. But I can guarantee for most of you in here, it will be very beneficial for you. We'll tighten a lot of stuff up in a matter of a few weeks that you might be spending months doing. Who knows? But it's a good acceleration program. I don't take any equity of your company at this point. We may later when we're done working with you. So the byproduct I get out of this, besides the $600, I get to sit down and work with you guys for a while. I get to understand how you guys work. We can try to identify some solid teams and get as many as you can out the road so you can actually get funded and become a real company. You know, now a lot of folks die in that vine going down that road, but we'll do what we can. We'll connect you to all the right people, and we'll try to make you successful. So if you're interested, let me know. Get my cards. If nothing else, send me an email so I can send you the deck. I'll send you the deck, and I'll send you that plan, a working copy of that plan, so you can type in it and just build it from there. That's about all I got for you tonight. Any more questions? All right.